gold equities right now are likely in a sweet spot. While many investment bankers are smarter than I, they exist to separate me from my money. I'm not interested. I don't care about small minds. So all of a sudden, what you find is that the community that you're competing with and attempting to front run is a community of 1,000 people. I don't feel threatened. The only subsector in precious metals that seems to be still out of favor is exploration. What I know about silver is this.
All right, Rick Rule, the man who's had more podcast introductions than I've had hot meals, and I've also been told you don't have as much time today as you're preparing for your conference, so we're gonna skip the intro here. Having mentioned the conference, might as well talk about it right now. Boca Raton, Florida, beautiful place that's coming in less than 40 days. To which, by the way, I also have the honor, and I don't say this lightly. I don't really ever use that word, but for that matter, but I do have the honor to be invited as an official media partner. So I hope I'm going to be there. And for everyone listening, there will be an affiliate link in the show notes or in the comments where you can buy your tickets to visit the Rick Rule Symposium in mid-July. That is 7 till 11th of July. It's going to either you visit it in real life in Florida, which is going to be very nice to meet you there and shake your hand, or you do it online on demand with, as always, both of those have Rick gives you, as always, a 100% money back guarantee. So there is very little risk in giving it a try, basically. And in the words of a wise friend of mine, this is an IQ test, so please don't fail it. That all said, Rick, I want to talk about something related to this conference, which is precious metals stocks specifically. Although they're not the focus of the conference, there's sure quite a few of them that are going to be there. But my question is really more about how do I approach them when I am there, because while gold is at an all-time high, the GDX, the GDXJ, the SAL, the SLAG, still way lower than what they were even just a few years ago, let alone at the 2010 sort of tops or mania, whatever you want to call it. And that's, it's a topic that's being well covered. Gold's moving, stocks are not. What do we do? But my question is mostly around what type of companies are safe to look into right now? When it comes to the conference, what type of companies do I talk to?
I wouldn't describe any investment as safe, depending on an investor's own definition of safe. I think the first thing that investors have to do before preparing to invest in gold is determine something about their own wants, needs, time preference, perception. I prefer that investors who are coming into the gold space start with an investment in gold itself, physical gold. If you think the material is going to go up in price, the first thing that you do is buy the material so that you don't have any operational financial risk. The second thing that I would prefer to see people do is invest in the highest quality gold companies on the planet. Yes, they have names: Franco-Nevada, Wheaton Precious, Agnico Eagle. People who have a track record of excellent deployment of capital, manage their balance sheet well, and people who have built the track record still being involved in the company. Boring investment advice, but the truth is, when we come into a gold equities bull market, the beta, which is to say the degree to which the gold equities market outpaces the broad market, is substantial enough that buying the highest quality companies as opposed to the more marginal companies, while it might give you slightly less investment performance, gives you much less risk. So I like the idea of de-risked beta, which is to say, capture the beta that you might get with the XAU, but buy the 5 or 6 best companies in the XAU, so that if your thesis is wrong, you lose less money. Perhaps you have 85% of the upside as 100% of as opposed to 100% of the upside, but you have 30% of the downside. So that's what I would suggest doing. To the extent that you want to take more risk in your portfolio, and I would suggest that people who are listening to me or Antonio listening to you are willing to take more risk. The first thing that you have to do is invest in yourself. You really need to have to understand how to analyze junior producers, developmental stage companies, pre-production companies, and exploration companies. And you have to define for yourself where you are on the risk spectrum. I used to illustrate this to new investors by asking them to pretend that they were at a lumber yard or in a millinery store. And I'll make this metric for the European viewers. In North America, we would call it a yardstick, but let's call it a meter stick. These old wooden things that you used to use to measure, as an example, fabric. The left side of the stick at 0 is very low risk, very low reward. The other end of the stick at a meter is very high risk, very high reward. So I would ask people to envision that as their portfolio and ask them how many centimeters from left to right they prefer to be. Now, everybody, of course, wants high reward and low risk, which is to say they want to bend the stick. The problem is if you bend the stick, it breaks. You can't do that. And an exercise that one needs to do before they build out their portfolio of speculative stocks is, first of all, learn enough so that they can understand the juxtaposition of risk to reward, and then determine where they are in terms of the trade-off between risk and reward in their own portfolio. I would suggest to you that gold equities right now are likely in a sweet spot. They have, as you suggested, substantially underperformed the bullion. The bullion continues to perform, but the bullion performs without much retail participation, just with central bank participation. I would suggest that one reason for the underperformance of gold stocks is that central banks don't by and large buy stocks, they buy physical metal. So the buyer is present in one market, which is to say the bullion market, but not present in the other. My belief is that we will begin to see retail participation in the bullion market, which will take bullion higher. We will overlay the central bank purchases with individual investor purchases. And I think when that happens, the consequence of that will be both that the gold narrative will attract adherence because the gold price goes up, and the emergence of a different class of buyer, which is to say living, breathing human beings, either individuals or institutions, will spill over into the equities. I think it's unlikely that the Chinese central bank, as an example, will ever be a buyer of gold stocks. But my suspicion is that as this bull market unfolds and individuals come in the market, they will be buying both the bullion and the stocks. And I think you'll see catch up. And for that reason, I think we're in a real sweet spot with the gold equities. I think gold goes higher. I think the sentiment extends over to them. But right now, they are, relative to their historical relationship, underpriced. The other part of the sweet spot is that you're starting to see financings take place. Now that the financing window is open up, now that some of the juniors are 20% off their bottom, what you're seeing is that the management teams are willing to do private placements. Not all of the private placements are on terms and conditions that I'm willing to participate in, but the truth is that the logjam has been broken. While I was looking aggressively to do private placements 6 months ago, the management teams weren't willing to give me any. They wanted to play just in time. They wanted to play chicken with capital. Now that their companies are up off the bottom, they are seeing this as a financing window. And so the availability of private placements is beginning to increase fairly dramatically. So, Antonio, that's a long-winded answer to your question, but I really see ourselves in a speculator's sweet spot around precious metals equities.
It's interesting you bringing up private placements and financings, because if people care about what you look for in those specifically, we did an interview about a month ago or so where we talked about warrants and how you look at warrants. I don't think you've ever done that before, at least not recently. So I'll link that in the show notes as well for people to see. They can go watch that. What I'm basically wondering here, and what you're telling me is kind of in line with what I've learned from Warren Buffett. Unfortunately, I haven't interviewed him personally, but I've watched a bunch of his stuff. So the company, he's got 4 rules. The company must be managed by vigilant leaders, is what he says. He says the company must have a clear long-term plan, and then the structure of the company must be stable and easy to understand. And then the shares of the company must be undervalued. And that's the part that I want to focus on here right now, because when I ask you about what type of stocks, I'm really asking what part of the Lassonde curve you would typically be interested in during situations like the current one, mostly because everybody's struggling. Like producers are struggling with lower cash flow margins, developers are struggling with higher interest rates for their build outs, and explorers are struggling with finding capital sometimes. That makes any type of sense because or are on conditions that are favorable to the company and its current shareholders because their paper is so cheap. And so, yeah, the question is about that last point from Warren Buffett. What is undervalued and what makes sense in terms of risk reward?
I think investors need to understand, first of all, a primary concept called net present value. Many investors don't. And I think what investors need to be able to do is either access a net present value model or be able to construct their own net present value. Understanding that you'll never get it right. You will only get it close to right. The search for perfection around valuation is a different form of procrastination. But basically, let's assume, for example, that a company has in their feasibility study 1 million ounces of proven reserves that they believe that they can reasonably produce. And they're going to produce this at the rate of 100,000 ounces a year for 10 years. What one would do is construct a very rough cash flow model. And I, for my gold price assumptions, use the forward strip, and then I hold it steady. And you use costs that I put in costs that are either from the feasibility study or from a comparison of similar operations in similar locales. And I escalate the costs myself somewhere between 3 and 5% per annum, unless I have better information. And you construct a very rough cash flow model. Receipts based on the gold price, costs based on actuals with an escalator. And then I use a uniform discount rate. In the gold business, the most commonly used discount rate is 5%. I consider that too low. Investment bankers use a 5% discount because they say that gold is an inflation hedge. I think the real reason they use a 5% discount rate is because if they use a higher discount rate, they can't get the valuations necessary to earn the fees for underwriting.
Yes,
so I use a 10% discount, understanding that I'm looking for a true valuation relative to rather than a relative valuation. And then I burden this whole calculation with a certainty factor, which is to say, how certain am I around the assumptions that went into the valuation? Do I want to assign the company a premium as a consequence of proven management? Are there discounts in place because I consider the jurisdiction that they're involved in to be fiscally or politically risky? But the most important part of doing the valuation discussion, I think, is the beginnings of a net present value calculation. Investors who either don't do it or don't find one are basically relying on that old speculative technology, got a hunch, bet a bunch. And that just doesn't work. If you are investing or speculating in companies that haven't reached that stage, then it becomes more difficult. It becomes more art than science in the sense that you have to do a risk-adjusted net present value calculation. Your net present value calculation really becomes a net asset valuation. A net asset valuation is nothing more than a net present value calculation in drag, where you are substituting assumptions, less well understood assumptions, for the assumptions which you might get from a feasibility study. I hope that helps.
It does help, but it also leaves a lot of room for error, especially if you're me.
Yes, and it's important, Antonio, that you understand, particularly people with an engineering or scientific background, that there isn't a right answer. There are only more right or less right answers. And the whole game is never believing that you're going to get a 10-year net present value calculation correct. What's important is that you outcompete your competitors. Not so tough to do because most of your competitors don't compete. They look at a whole variety of factors to allow themselves the psychological space to do what they wanted to do at the beginning of the exercise.
Hmm. Yeah, well, when you're running away from a bear, it's not important to be faster than the bear. You just have to be faster than your friends.
That is
Uh,
correct.
Now, one potentially right answer here with some of these, or at least one answer that helps you stay away from the wrong answer is it comes from Lobo Tigre. I talked to Lobo Tigre on here as well a lot. And
Yep.
so he's currently holding the stance that if you bought a small cap stock specifically instead of physical gold, as you mentioned, with the idea of getting some type of an alpha or leverage over the gold price, and that stock hasn't even moved yet with the gold price having gone from what 1800 to almost 2500, then you have to consider the possibility that there's something wrong with that company. Is that something you just agree with, or is there more to it?
No, I have a lot of respect for Lobo, but I suspect that Lobo has to make some simple declarative statements and has to make some one-size-fits-all statements in order to sell newsletters. I prefer to take every single investment decision in isolation. A small company might move, or pardon me, might not move in your portfolio because you didn't take into account all of the relevant factors. But it also might move because it doesn't have institutional support. I mean, there can be a whole bunch of reasons why things don't move. Part of the game involved in speculation is to find something that hasn't moved, determine why, and decide whether you're right or the market's right. I've had several circumstances in my life. I remember Francisco Gold years ago in particular, where we identified what we considered to be real value, and the stock went down. The stock going down caused me some momentary psychological trauma. So I was, in conjunction with my then geologist, Brent Cook, able to do a really forensic deep dive into the exploration upside of the company, the data, the probability of success, and the price that we were paying for that success. And we determined, in fact, that we were right and the market was wrong. And those are really sweet spots in your investment career. The other work that Lobo Tigre has done, however, which is also a simple declarative statement that seems to be right, is his pre-production sweet spot.
Yeah.
He postulates, based on a fair bit of data, that companies that have made the production decision and have also overcome all the obstacles to production, which is to say permitting and financing, from the time that the first shovel is turned until the time that they reach economic completion, is, from his point in time, the most propitious segment of the Lassonde Curve, that in fact you're out of the boring phase, the so-called pre-production boring phase, and into a re-rate. I have to say I was skeptical when I first looked at this. I couldn't understand why it would be right. But when I suspended my skepticism and asked an intern to check it statistically, it turned out that irrespective of my preferences, it was right, which is interesting. I guess the explanation for that is that earlier in the curve, people don't have the same stomach that I have for risk, and they have a time preference that can be accommodated in construction, which is to say, from commencement of construction to commissioning of plant, maybe 2 years. If you come earlier in the time in the Lassonde curve, in the so-called boring phase, you only have indications of time. You have no answer to your question around time preference. In other words, I'm trying to figure out why a rule of thumb, rules of thumb seldom work, why that one does work. And the best explanations I can give is certainty and time preference.
And also supposedly people smarter than you, and I say supposedly here, as an investment bankers have looked at this and have given it a green light. I suppose that's a big part of his thesis too.
I have normally found that while many investment bankers are smarter than I, they exist to separate me from my money. And so I have not necessarily viewed their conclusion in a neutral light. I have considered that most of their research report, their so-called research, is sales and drag. So while I understand what you're saying in terms of their being smarter than I, and I concur, I know lots of them, I'm not suggesting to you that from an investor's point of view, they're necessarily benign.
Yeah. Yeah. And then it goes, I suppose, back to sell side versus buy side, which most of it is sell side. Most of the research we really see is sell side, which
Yep.
at the beginning of my career, I took it like I thought I was getting access to some, specific information. I thought it was on top of the world. And I didn't realize it's really marketing pieces. So that's kind of how I treat sell side reports. And that's how people should treat pretty much any content that you happen to stumble on online that is about a company. I treat it as marketing.
Yep.
Anyways, there's a whole series, by the way, I did with Lobo on the pre-production sweet spot. I think it's 6 episodes of over 2 hours. There's a bunch of the stuff that I probably link in the show notes, but people can get to that as well. And the main point, that's something that Lobo didn't want to give away because that's where the pitch for this newsletter comes in, was how do you front run the pre-production sweet spot? Like, what is the pre-production sweet spot, and what do I look for in this
I,
specific market environment?
I don't think you need to do it.
Okay.
People try to get too cute. You're trying to add 7 or 8% to the expected accretion of beta over time. I don't think you need to do it. I mean, I could give you a very long-winded answer, but the beauty of what Lobo did is he identified for you a technique that on balance has generated 100% returns over 2 or 2.5 years.
Hmm.
The fact that you can do that without an awful lot of work, and you can refine his thing, perhaps for myself as an example, if the feasibility study didn't generate 2.5–3 billion dollars worth of in situ recoverable reserves, I'm not interested. I don't care about small mines. So I can refine his pre-production sweet spot to take into account my parameters. I might say for myself that if the return on capital employed didn't exceed 25%, or if the return on capital employed wasn't in the best quartile of competing projects worldwide, I didn't want to invest.
Hmm.
Or if the feasibility study didn't warrant the company's inclusion as being in the best quartile worldwide in AISC, I can modify what he's doing. But to the extent that 5 or 6 or 7 companies a year meet his criterion, which is to say shovel ready or shovel turned, the idea that technique is going to give you somewhere between 5 and 10 investable ideas a year makes it extremely valuable. And the idea that you would want to front run an idea, first of all, that, while right, doesn't have any market absorption, and secondly, take away the beauty of the idea, which is to say that you don't have to work too hard to employ it. That's of limited utility to me.
Hmm. I would have thought you had a different answer for this because of you specifically hammering the point of being contrarian home multiple times. Because at this stage, when a project is shovel ready, everyone knows that it's shovel ready. So are you being a contrarian at that point?
Everybody knows. Let's think about that. How many people in the investing world have ever heard of Lobo Tigre?
Hmm.
Or for that matter, Rick Rule? I think you are talking about an observation, which is to say the pre-production sweet spot, that has pretty broad currency in our world. But our world has an extraordinarily low population. And most of them, in truth, in a bad market, don't have the courage to pull the trigger anyway. Let's suppose that there are 50,000 people who have heard of Lobo Tigre. And let's suppose that 5% of those are subscribers to Lobo Tigre. So that community becomes 2,500. And let's suppose that the probability of that 2,500 people pulling the trigger on any particular idea is constrained by their own macro view, or frankly, whether they're having an argument with their husband or wife. So all of a sudden, what you find is that the community that you're competing with and attempting to front run is a community of 1,000 people. I don't feel threatened. Now, I could think about other work that I like to do, which is to say that the hate, the part of the thesis that Lobo is about is the fact that when a company is shovel ready, that you've diminished some of the hate around time preference. I can understand that. And the way that I try to deal with that is I try to look at the net present value calculation around the pre-feasibility study or even the preliminary economic assessment. And I try in my mind to construct a very, very, very rough pro forma valuation, taking in new resource documentation and better documentation around prices and costs, which is to say, what I try to do is look at companies where the net present value described in the feasibility study is going to be substantially greater for reasons that I understand than in earlier studies. In other words, I try to arbitrage the probability of better information in the process that I have described before in interviews with you as speculating on the answers to unanswered questions. I mean, first of all, that's difficult. The second thing is in terms of constructing an investment framework around that that's suitable to large numbers of people, Lobo's work has been better than mine. He has simplified the whole process. And as I say, I didn't believe it could be true until I assigned an intern to do some backward-looking statistical analysis and found out despite my skepticism, it was true.
Well, combining that, actually, that last part that you assigned an intern to do that work, and also what we previously said as to I have to just be quicker than my friends, not the bear.
Yep.
I'm also reminded of a comment that I read under one of our recent interviews where someone said something along the lines of, why do you even ask Rick Rule how to do it when he gets deals that you would never even get? Like, there's no way for you to outrun Rick Rule. Like, he's always going to outcompete you because of the access to deal flow, which I actually know for a fact is not true.
It isn't true. It absolutely isn't true. There's 3,000 public companies out there. I'm 71 years of age. I don't care at all about 2,700 of them. They have to do something truly spectacular by way of a drill hole to interest me. I am interested in companies that have investors who I know and love and trust, or are run by people whom I know and love and trust. You have a much less formed group of prejudices than I. And I mean, the other thing, quite frankly, is I invest in companies that can move the dial for me and my network. And me and my network are larger than you and your network. So something that I don't think can hold the capital that I would bring to it if I like it, which is to say an opportunity that isn't germane to me, can be much more germane to somebody like you. You have a much greater opportunity set than I ever will now.
Yeah, and just FYI, Rick, this interview is going to be launched tomorrow, not in 24 years. So I don't know why you're saying you're 71 years of age, because tomorrow I'm sure you're not going to be 71 years of age. In 24 years, maybe you will be. But anyways, what are such companies here, though, that you think can hold your capital, but also present that same opportunity at the pre-production sweet spot?
Well, I need to say, I'm right now, because the only subsector in precious metals that seems to be still out of favor is exploration. I'm coming down well below the pre-production sweet spot. And I don't have any specific companies as we speak that qualify for what Lobo would say were starter kit pre-production sweet spot investments. In other words, there is nothing that I see that is financed, permitted, and commencing construction. If you take us back a year and a half, you will recall that I talked on your program about G mining after they completed the financing, after they completed the permitting. Now, it's probably misleading to point to the success of that speculation. It wasn't just pre-production sweet spot. It was one of the best mine build teams in the world. And they came into the pre-production sweet spot during a time when the gold price went from $1,900 to $2,400. So there were various factors that had to do with that success. But the truth is, it would have fit neatly into Lobo's model. I'm not aware of any conjunction between my model and Lobo's model right now, so that I could name names around the pre-production sweet spot.
And I suppose for the exploration companies you do like, they're going to be, you're interviewing them on your own channel, right? Rule Investment Media.
Yeah, well, I'm interviewing companies on my own channel. They're going to be at my conference.
Okay.
I'm doing that because in the conference we only have 4 days, and in 4 days we have 60 hours of programming. It's impossible for my attendees to absorb all of the information and make investment decisions during that 4 days. It's impossible. So I want our attendees to have the ability before the conference to have an overview of every single exhibitor there, so that they can then download the annual report, the quarterly report, that kind of thing, and also reach out to the companies. I overcome the tyranny of time by expanding the time available to me. 2.5 months before the conference and sort of a month after the conference. That's really what that's about. What you will see in the Rule Classroom and Rule Investment Media going forward will be my interviews of companies not unlike what you're doing, that wonderful work that you're doing with the barbecue. I want to start doing, really deep dives into companies. I admire the work that you've done, and more of us need to do that from different point of view. So you will see that from Rule Investment Media. What you're seeing right now at Rule Investment Media and the classroom, though, are really interviews that are meant to be done in conjunction with the conference. People who aren't going to the conference are, of course, welcome to watch the interviews. You will note in every interview that there's an embedded advertisement for the conference. So, hence my willingness to share those interviews on YouTube.
Yeah, and plane tickets are expensive to get from Belgium to Florida, so that's why I'm bringing it up too, because then I can sell some tickets and pay for my plane.
Well, the other, I mean, further to that, remember last year we had attendees from 33 countries at the conference via live stream. People didn't have to buy the ticket. My definite preference, make no mistake, at conferences is to attend live, not just mine, but others.
Yep.
I had an email 3 years ago from an attendee saying the ability to follow Robert Friedland around my exhibit floor and see which public company issuers he stopped in front of, who he asked questions to, and even on 2 occasions, the ability to lurk and listen to the questions and the answer was worth more than the cost of admission, that they got the whole rest of the conference for free. And you can't do that live stream. You can't do that. In person, you can come on the boat cruise. You can watch the issuers and the gurus after I've poured a little bit of bourbon into them, have discussions that you might not see other places. There's a lot of communication that takes place that is best observed live. But if you can't, the live stream is a wonderful, wonderful fallback position.
Yeah. Although, again, some of the best conversations for me have happened in the washing room so far of conferences.
Yep.
So funny thing there. You brought up the gold price there, Rick, and that's something I wanted to touch upon as well, because there's an annual report that you're likely well aware of, written by Ronnie Stufferly, and it's called
Wonderful piece of work, by the way. Wonderful.
It's 500 pages, so it is.
Yep.
I haven't gone through it completely yet, but so I'm reading some of the ways that he basically did some calculations. So some of the ways that he approaches price targeting, if you will, essentially
Yep.
coming up with a price target of what is very close to $5,000. It was specifically, and I wrote it down, $4,821 by 2030 is what he claimed. And I've also noticed sort of a trend, if you will, on YouTube and other financial media that when you have huge price targets, or they don't even have to be huge anymore, they just have to be attention-grabbing price targets for asset prices, then yeah, those videos get higher views, right? It happens with me too. When I have a guest on who claims crazy price targets will be high or low for gold, it gets a lot of views. But
Yep.
given that this is what everyone is attracted to, again, in the realm of attempting to become a contrarian myself, I'm thinking, is this maybe overall the wrong way to look at this market in the first place, like based on price targets, or attempt to value a metal which is supposed to be insurance more than it is it's a producing asset? So what I mean, what do you think in general about price targets?
Well, what I like about Ronnie's is that he gives you his methodology, which I think is much more important than his target. The target is just an excuse to do something that you wanted to do anyway. It's really bullshit. What's lovely about the way that Ronnie goes about it is that he sets out the assumption reaching the target.
Mm.
And the idea that you look at his range of assumptions and you can analyze them individually as to whether or not you think that those are valid. If you just decide yourself, I think that there's a 60% or 65% probability that the gold price is materially higher 5 years from now than it is today. That's much more important than $4,877.
Mm.
From my point of view. The other thing that I like about Ron and his team is that they put so much thought into it that I get to scab their thought. I don't need to have spent my whole year dreaming up the right gold price assessment methodology because they've done it. And I get to absorb the parts of their thesis that I think are valid, and I get to discard those parts of their thesis that I think are preposterous, which is great. I mean, I can absorb a whole year's worth of work that they did in 10 minutes. And by doing so, I can save myself probably 10 hours. That to me is much more important than whatever number they use. Not too long ago, I did an interview that, I even forget who it was with, maybe Daniela Camboni, wonderful interviewer. And I told her that I didn't own gold because I thought it might go from 2,400 to 2,500 or something like that. I owned it because I was afraid it would go to some number like 7,500. What caused people to pay attention was this $7,500 number. And that number was just an illustration. The underlying concept that gold was insurance, that it wasn't anything else, meant nothing to most of the viewers, which I think was very unfortunate. The $7,500 number, which allowed them to grasp a factoid,
Yeah.
a floating abstraction, and use that as an excuse to do something that they were otherwise thinking of doing, I think is a very unfortunate tendency.
It is. I 100% agree, because there's the same is true actually for stock tips, where like I would love to spend 1 hour, 2 hours, 3 hours talking to you or Lobo Tigre about methodologies as to how to pick the right stocks. They get substantially fewer views than if I put in Rick Rule's top 20 stocks. I think that's one of the most watched videos on my channel, actually. Rick Rule's whatever. And I mean, people see it, and then every time they invite you on, they want to talk to you about what are you buying, Rick? What are your favorite stocks? And then people want to hear that and buy that. No methodologies, no nothing. So it is an unfortunate development that I think eventually is going to have to change because of this. We're not here to analyze the podcasting market, but there seems to be an oversupply in the podcasting market, and I think eventually that cures itself, as you like saying. But we're talking about gold and silver, though. What do you do you have the same thoughts for silver? Because silver is more of a given its dual nature, where it's industrial and monetary. Can you value silver?
No, I can't. I've been trying to understand the silver market for a very, very, very long time. I know it to be based on experience. more volatile to the upside and the downside than gold. But to do old-fashioned commodity price forecasting with silver is an impossibility. In the first instance, silver is both an industrial material and a monetary metal. So you have to look at supply and demand from two different viewpoints, not one viewpoint. The second thing is that the silver supply is nebulous and not primarily dependent on silver mine production. New mine production is what, 16, 17% of silver supply, new supply. Most of the supply is production from base metals, let's just say lead, zinc, copper, or gold mines. And the consequence of that is that the silver price isn't the primary determinant of silver production. The copper price, the lead price, and the zinc price are probably all more relevant to silver supply than the silver price.
Yeah.
The third thing is that still most of the silver that's ever been mined is still supply. And that supply is broadly held. And buyers and sellers have different motivations. An example would be I think sometime in the 1990s, Warren Buffett disclosed to the fact that he had bought about 15% of the known LME or COMEX known inventory in the world in silver, and the silver price shot way up as a consequence of, the Buffett imprimatur. And then the silver price collapsed. It just collapsed. And of course, the silver bugs had all kinds of, the Trilateral Commission, the International Jewish Conspiracy, all this JP Morgan Chase. It turned out that what happened was that the silver price doubled in US dollar terms, and the Indian rupiah fell by half in US dollar terms. So for Indian people, the silver price went up fourfold in about 9 months. And that coincided with a very poor harvest in India. And rural Indians had a choice between selling an asset that had experienced fourfold escalation or not being able to fund their children's education or feed their families. And so you had this huge rush of silver that came out of India. And it's precisely because the structure of the market, the structure of the inventory, and the structure of silver demand is so diffuse, it's very, very, very difficult to understand. If you tried to understand investment demand around silver, would the current strength of the Indian economy, would good weather in India, which might cause us to have a good harvest in India, and hence allow the peasantry to save and invest more. Historically, they've saved in silver rather than in rupiah. Impact the story. What I'm trying to say is I've spent 45 years trying to understand the silver market, and I would suggest that I'm on my way to a PhD, but I'm only in the third grade still after 45 years of trying. What I know about silver is this. Quantum increases in price are a function of investment hoarding or dishoarding. Industrial demand with regards to silver has been sort of baseload demand, but it doesn't generate alpha in either direction. The silver market as an investment market requires the gold market to lead. Narrative momentum comes from gold. When the generalist investor comes into the precious metals market as a consequence of the momentum in gold, and they come down into the silver space, the movement in silver, both the metal itself and the equities, becomes much faster and much more dramatic. When and how, I don't know. I just know that. I don't know why either. You and I had an interview 3 or 4 months ago where I talked about the fact that I like the silver equities precisely because people hated them. And in my experience, the best speculative moves are in sectors that go from hated to being tolerated to being liked to being loved. And I think that the move that you've seen in the last 3 or 4 months in the silver space, in the silver equity space, reflects nothing more than the fact that the space isn't hated anymore. You'll remember when you and I started interviews in 2022, the hated commodity was uranium. I would say something positive in your interviews, and you had about 7 viewers then, but 2 or 3 of them would express displeasure that some old man was talking about a has-been commodity, which is to say uranium. Now all those people would probably be paying me for uranium stock tips. And it's important to note as a speculator that the easiest money is made in sectors that are broadly owned and broadly hated. The silver stocks have passed out of that now. I'm not going to say that the easy money has all been made, but a lot of the easy money has been made abandoning hate.
Silver's still not at its nominal all-time high, so it's actually quite far away from it. What I'm wondering, what I wrote down when you said when you talked about the relation between gold and silver is that, well, I'm thinking, is this just normal market dynamics, or are there other sort of insights to be taken away from the relationship between the two metals as they are right now?
That's funny. I'm going to a dinner next week, and the topic of the dinner is do ratios matter?
Do they?
Are they just rules of thumb that observe history but have no relevance? Or do they have relevance? People tell me that silver is stupidly undervalued because it's 16 times as prevalent in the world's crust as gold, but gold sells for, X number of more. In other words, does the gold-silver ratio matter? Does the gold-silver ratio have anything to do with utility? Does it have anything to do with operating margin? Does it have anything to do really with supply? I'm not sure it does. Does the fact that gold is nominally, although not really, at all-time highs, and silver isn't, have anything to do with anything? I'm not saying it doesn't, but it might have to do with the partial influence of industrial demand on silver rather than gold. I don't know. I'm interested in the question, though. Rules of thumb sell newsletters. They are very useful to investment bankers to establish paradigm, to generate fees. I just wonder if they matter beyond that.
That's the same thing that I'm wondering. I'm leaning more towards no, because I've started operating on the basis of the framework that finance is largely made up and it just doesn't exist. It's really meant to generate fees. I don't know if that makes any sense. Maybe I'll change my mind soon. But there's maybe ratios like platinum and palladium that matter because they can substitute each other. Is that something?
Well, I think, yeah, no, I think that's very right. I think that's broadly knowable. When platinum was selling for twice the price of palladium, fabricators began to work on palladium technologies to substitute palladium for platinum. And that caused a whole bunch of fabrication technologies to favor palladium over platinum. And the consequence of that, and some supply disruption in the platinum space, caused palladium to greatly outpace platinum. Now what's happening is that the metallurgists and people like that are working on a whole bunch of platinum technologies to substitute platinum for palladium and things like auto catalysts and power plants and stuff like that. And who knows, maybe you'll see a reversion of that. I think you have to do the hard work around stuff like that. You have to examine the relative utilities of both materials in the production chain and look at the price disparity between the two commodities relative to their ability to generate utility for fabricators. I mean, that whole sentence is boring. And most investors, when they hear that discussion, likely are thinking, I want to go for a beer, or won't you just give me 3 stocks that'll double by Christmas and let me get off this podcast? But it's asking yourself questions like that generate superior performance over time.
I think the few people who have stuck around sort of tour this, which must have been like 15 minutes or something like that we're talking about so far, are the more serious crowd, so they can appreciate that. What I don't necessarily appreciate about platinum, though, is that I find it virtually impossible to get exposure to it if it's not the physical stuff, because I also want to have, look at every issuer separately, and most of them have challenging metallurgy, challenging jurisdictions. They're messed up with other stuff. And so it just makes it, I haven't found anything that I like within platinum. What about you?
I'm right with you. I mean, in an ideal world, I'd own Norilsk. As an American, particularly an American with a bank in for approval, so not wanting to earn the ire of my government, owning Norilsk is not something I can do. I found myself in a default space owning commercial for a past employer, the Sprott Physical Platinum and Palladium Trust. If you think the material is going to go up in price, buy the material first. So I've done that. When I look at the platinum companies, there's some great companies in the world, Anglo-Platts, Sibanye-Stillwater. The difficulty is with South African production. I think South Africa is an impending basket case. And South African production is really challenged. The political disruption in South Africa, the ANC and the EFF, cause platinum companies to wonder who will own those deposits in 10 years. Will they be outright nationalized, or will they be slow motion nationalized? And that uncertainty as to security of tenure has caused the platinum industry to underinvest in capital, become more reliant on labor. The labor, because they're inefficient, they don't employ much capital, and they aren't well trained, are underpaid. The workers' wages have to go up, but they're inefficient, so they can't go up. The industry truly, in mining parlance, is between a rock and a hard place. So I can't own the Russian ones because I'm American and they're Russian. And I can't own the South African ones. So what is left? Zimbabwe? I mean, Zimbabwe aspires to be a basket case. That's the upside for Zimbabwe. So what I'm forced to do is look around the world for potential tier 1 platinum and palladium explorers and developers, where I don't have to worry too much about the current price malaise, and where they're in jurisdictions that aren't any of South Africa, Zimbabwe, and Russia. And that in itself means that I'm pushed out on the risk curve farther than most people want to go. And it means that my opportunity set is really, really constrained.
But haven't you heard, Rick? Zimbabwe is going to do a gold-backed currency. They just have to find some gold. That's the only requirement there. This is, as always, this has been great, Rick. I really appreciate you doing this. And for people listening, again, there will be a link to Rick's conference in the description of this video. Please do check it out. It is an affiliate link, as I mentioned earlier. But Rick, I know you have to go now. So thank you for being here. Hopefully speak soon, or I'll see you in Florida anytime, in about 40 days, as I mentioned. I'll let you drop off now, though, as I'll be moving over to the CEO barbecue portion of today's Real Money Talks. But first, there is a warning on your screen right now, as there always is, and I will need you to read that before we continue. It's not just some disclaimer, it's an actual warning that is aimed at helping you stop losing money based on these things, or prevent you from losing money, whatever it might be. Because although I am obviously here to make money myself, it's no secret that here at Resource Talks, we do try to be different than other channels. The main thing we try to do that is by not hating the viewer. Rarity out there. What that means specifically is that I would like you to be aware of the fact that 2 of the 3 companies that you will see in here have paid for the production of their interviews. I will disclose which one as we're going into those interviews again, but it's Ridgeline and Torq Resources. They are also likely seeing their participation in this program as a chance to do some marketing. So start by understanding that thing first, but also just be aware of the fact that other interview channels out there, this interview channel, other interview channels out there who interviewed CEOs or talk about companies and stuff like that, talk about these subjects, they typically earn money by charging for the creation and publication of these interviews, even though most will not be as vocal about it. And so you need to be aware of that fact. And there's no buy or sell recommendations being made here. That's not something I do because there's a clear conflict of interest with companies paying you to give them a buy recommendation. Many will do it that way, so you should be aware of that fact. Anytime you're just watching any type of company-specific content, as I always say, just approach it with a dose of skepticism. And if you're feeling frisky, you might even use your brain while watching that content. But also, I try to do a decent amount of research when I do these interviews. I still don't give the companies the questions up front. There are no questions off the table, and the companies get no say in what ends up in the final video. I don't sign any release forms or waivers or anything like that. Even though that's the case, these things should still be looked at as advertisements and not as independent research. Okay, and least of all as recommendations. None of us know what we're doing. Otherwise, we wouldn't be making videos for a living. We'd be investing for a living. So no guarantees here, besides that there will be forward-looking statements made in these conversations, and also a guarantee that these conversations will be general and impersonal in nature. They are going to contain hopes for future events that may or may not take place, depending on many different factors that are both within the company's control, but also outside of the company's control. So be aware of that, and please talk to a professional investment advisor, and please do more research before taking any decisions by visiting setterplus.ca, where you're going to find the company's official filings. There are disclaimers on your screen right now. Again, as I said, if you don't enjoy losing money, read them and be careful out there. Just be cognizant of what's happening. With all that said, though, I am gonna go into the first CEO barbecue for this week, for which I will be traveling to the Western U.S. to get an update on 5 precious and base metals projects, actually, from Chad Peters, the CEO of RIDGELINE Minerals, again, a company that is paying for the production of this interview. The company is listed as RDG on the TSX Ventures Exchange, where an average of about 200,000 shares trade each day with a 52-week high, 23 cents, and a 52-week low of about 8 cents. With a market cap of $16.5 million and about 110 million shares outstanding, today this is a 15-cent stock. There are 27 million options, most of which at 30 cents. There's some at 18 cents as well. And then there's also 5 million options and 1.2 million RSUs, resulting in 143 million fully diluted shares. About 8% of the company, so 8, not 80. That sounds like 80. That would be nice, though, for Chad specifically. So it is 8% of the company is owned by insiders, a little over 3% by Chad himself, by the way, with other large holders, including Rick Roll himself, EMX Royalty, and Stevens Investment Management in there as well. Looking at the latest balance sheet, which is dated December 31, the company had about $680,000 in current assets at the time, most of which, so $500,000 again back then, was, to be specific, was in cash. There have been changes since then, though, and I'll tell you more about it here in a second. And account payables and accrued liabilities, as well as the current portion of a loan and a lease facility, came in at a total of not a lot, about $120,000 in current liabilities, while non-current liabilities came in, again, not a lot, at around $76,000 for a total of, call it $200,000 in total liabilities. That same financial statement also tells me that on average, over the last reported fiscal year, Ridgeline spent about $70,000 a month on administrative expenses, which is about in line with what they were spending on G&A during the same period of last year, whereas the exploration and evaluation expense of the properties came in at over $200,000 a month. And so to put it simply, that means that, and I'm excluding stuff like share-based compensation and whatnot, and I'm rounding up as well, the company spent a total of $270,000 a month on average over the last reported period there, about 75% of which went into the ground, so exploration and evaluation of the assets, and a little over 20% into 25%, that is, into G&A. You guessed it, though, this financial statement is only a snapshot in time. It is also dated by this point. In this case, it was specifically at the end of December of last year, and the finances will have changed by the time you're watching this. So please head over to the company's official website as well as setterplus.ca to look at the numbers yourself to make sure you're getting a full picture, because again, non-revenue generating company that relies on public financings, And there also have been, as I mentioned, financing activities since the statement was published, where Ridgeline closed an oversubscribed $2.2 million private placement, which we'll talk about later on. That all said, no lengthy company overview here needed, as Chad and I spoke just a few weeks ago, did a deep dive on what Ridgeline is and does and where it wants to go. So I'll link that somewhere in the description, or somewhere in the comments or whatever. But in a nutshell, as a loyal listener and a viewer will remember, this is kind of a hybrid story, if you will, where Ridgeline looks for assets, they work them, and then they either option them off or sell them, monetizing them in whatever way works, or the ones that they really, really like the ones that we're going to be talking about today, they keep for their own exploration and drilling efforts. The focus for now is Nevada. As I said, the US, there are 5 such assets that are in Nevada, spread across 3 different mineral trends over there, with one in the northern part of the Battle Mountain Trend called Swift. This is a $30 million earn-in agreement with Nevada Gold Mines, which is a Barrick Newmont joint venture, by the way. And then there's on the Carlin Trend, there's a deposit which is to the west from the is it? No, it's to the east from the Battle Mountain Trend, and that is where Black Ridge is, which is another earn-in option agreement with Nevada Gold Mines for $10 million. So that's $40 million in total in those 2 option agreements. And right next to that project is where the Bell Creek project is. This is a gold target, currently 100% held by Ridgeline. And then the real focus, though, comes in with the Big Blue and Salina properties a little bit to the east from that as well, with those 2 being porphyry targets. And so Salina specifically being the main focus for the company because it basically checks all the boxes from Dr. Peter McGough's CRD checklist. And it's also where a large geophysical anomaly at depth has created worthwhile targets. Again, we discussed that in depth during the last interview that I did with Chad. And Chad, I think the main thing since, about a month or so since you and I spoke, has been the financing. You set out to do a $1.2 million financing, which essentially doubled after that almost to 2.2. And so while I understand the concept of upsized financings, and while it seems like the market appreciates upsized financings now, I'm also wondering why twice as much money, and of course wondering what exactly you're going to do with it. So talk to me about that. Take it away.
Sure. So when we first decided to announce the financing, when we were looking at, okay, what are we going to go out with? 1.2 was like the absolute bare minimum we had to raise, right? Like that was like the keep the lights on, money for the rest of the year. And we didn't want to get ahead of ourselves and say, hey, we're going after 2. Still been a really weird market, honestly. Things are really starting to pick up since we announced, but I think in late April when we actually announced or mid-April when we announced the financing, it was still a bit of a weird time in the markets, right? So we weren't confident we were going to necessarily get a huge response. Luckily for us, we did get a really strong response from shareholders. That was also timed well with Nevada Gold Mines announcing that they were going to be doing a $5 million spend on our projects this year. So I think it did kick a little bit of a shot in the arm for the company with that. And Rick Rule came in, did his initial order, and then halfway through doubled his order again. So we were really excited to have Rick heavily involved, and that brought in some really great shareholders as well. And it was pretty much a rights offering, almost all existing shareholders, mix of institutions and high net worth. And yeah, we wanted to make sure if we're placing more shares, we want to be placing with the right shareholders, right? And that's why I'm always willing to upsize if it's for the right shareholders.
Right. So, but was there was Rick a lead order in this? Was there a lead order here?
Yeah, Rick and 2 other groups kind of all came together at the same time, which brought in a pretty sizable, they didn't do it together, but they all kind of said at the same time, hey, I'm going to do a big order, which allowed us to kind of fill almost 30-40% of the original book. Well, it filled over 50% of the original book just right out the gate. And then it grew pretty quickly from there.
Okay. How many people in total do you think participated? Well, you probably saw the sheet, so.
Yeah, off the top of my head, I don't know. That's a good question. Probably around 60 people or something like that, I'd guess.
Okay.
Yeah, something in that range. Yeah, but I don't have the exact number on the top of my head.
Do you have an idea, and it doesn't have to be a specific number, but sort of, again, off the top of your head, how many people you have in the story right now, like a rough number, like in total shareholders?
No, we have, we certainly have, folks that I can look at our, past financing lists and look at. We have easily, 300-400 names that we can pull off that have participated over the last, call it, 3-4 years. I think probably based on, kind of the retail side of things, we have, probably in the thousands as far as, actual shareholders, I'm sure. But yeah, probably 300-400 that I could look at and give a call.
Okay. And how like, what percentage of the company do you think the top 10 shareholders would own here?
Top 10, let me see. I'm one of them, which is a nice thing. I'm happy to say that I'm still in that top 10, but
I'm sorry it's not 80%, by the way. I wish it was
oh
for you.
man, I wish it was 80%. That'd be phenomenal. Let me just do the math here in my head. My wife will be laughing at me doing math on live TV here. Probably around 35%, maybe even close to 40 would be owned by kind of the top 10
Okay, wow.
shareholders and insiders. Yeah. So
Good.
pretty nice. It is a fairly tight share flow within our top group.
That's what I was getting at.
Yeah.
I could have asked you just that, but I appreciate us getting there in a more complicated way. That's always the right way to do it, I
Oh,
suppose.
that's the fun way to do it. Yeah.
But okay, so using the money,
Yeah.
2.2 million bucks. What am I getting for the extra 1.1 million bucks specifically? Where's that going?
Yeah, sure. So we wanted to make sure that, like, I wanted to be able to say, okay, if the markets do end up, maybe I think we were all a little bit like, is this actually a real turn in the markets? Is this a bull run, or are we just in another, kind of little gaslight event here and it's going to go right back down again? So we wanted to make sure that we raised enough to comfortably last a full year, expiration, G&A, everything. But what it allows us to do, I think this year really effectively, is we're able to go out, we're going to do a 3D IP survey at our Big Blue project, which is a really exciting potential porphyry copper play that's never been drilled in the area that we think we might have a nice porphyry play. So that's kind of the same playbook as what most copper groups, including like Hercules, right? That's what cracked open their project. They did a big, deep 3D IP survey, identified an anomaly and drilled it, and rest is history. That's what we're trying to do at Big Blue. We're also going to be acquiring more ground. We're staking more ground actively in Nevada at the moment. Kind of thing. So we're in the same general trend and style of deposits that we've been pretty active with over the last few years. So we're going to be staking more ground. We're going to be doing the geophysics. We're advancing advanced permitting initiatives at our Salina project, which isn't cheap and it takes time, but it is worthwhile. We know we have something significant at Salina. And so we're doing a plan of operations permit with the BLM that allows for over 200 acres of disturbance. And we're also permitting a water well at the same time. So an active production water well. So what that'll do is, once those are both approved, which should be in the first half of this year, maybe early July at the latest, that'll allow us to take that project all the way to development if we continue to advance it. So it's a pretty important de-risking event for the project. And so that's more of a little bit of a little less excitement, I guess you could say, in the first half of the year at Salina, just because we want to get that out the gate. But yeah, between the mix of the geophysics at Big Blue, staking more ground, advancing Salina, it allows us to be aggressive. And, if we really like what we see at Big Blue, there's also potential to throw a few quick holes down on that target as well late in the fall. So that's kind of that little buffer of cash that we raised kind of allows for that if we chose to move forward.
So you're going to look at some fishes and then some birds this year then to permit Salina.
Yeah, well, the lucky thing is we've already dealt with the birds, the fish. It's all desert, so luckily there's no fish around. But we've done all the bird surveys, all the biology, archaeology surveys. Everything's done. The permit is actually in public comment right now, which just means pretty much it gives an opportunity for any resident to comment on the permit, and we'll address any comments that come through, and then pretty much the permit's approved. So we're in the 11th hour of that process, you could say.
Well, what's the biggest challenge then here in this last hour of completion? Like what could go wrong, and what would you wave away if you could wave a magic stick at it?
I'm not really concerned at this point. All the major hurdles have been already passed. Public comment is very simple. Like you'll get everything from very concise comments from NGOs and groups that want you to address certain items, or comment on noise pollution or dust pollution, etc. And you just have to address it, right? Like and then I'll get people that are we'll get folks that are just locals living there that want to know their comment is where they can send their resume for a job, right? So there's a wide range of comments that get sent in, and they're all pretty easy to address. So yeah, it's I'm not concerned about getting the permit approved at the moment. I just would like to, if I could snap my fingers, I'd jump ahead a month. But aside from that, it's going to go good.
Well, I'm also wondering why even, given what you think or hope to have at Salina, why even do something on Big Blue, and why even do anything in terms of buying more ground? Why not just preserve the capital, wait till you have the permits, and then just drill Salina and keep it sort of simple that way?
Sure. Yeah, I mean, look, like that's certainly an option, and we discussed that as a potential strategy for the company. I personally don't like relying on any one project, right? I mean, at the end of the day, Selena, for example, is still early stage. We're really excited about it, right? It does pre-resource, and there's a lot of things that have to go right to get Selena to a point where it becomes a, something that we're permitting towards a mine. So I always want to have 2 or 3 projects always running in our portfolio, and we call it our pipeline of projects. We have everything, like Big Blue is early stage. Selena is much more advanced. And then the project that we're staking, that we would end up staking, right? That's the kind of thing where you're doing soil samples, prospecting, and mapping, right? So we try to have at least one project at every stage of the exploration process. Ideally, as you drill a great hole at Selena and it really takes off, well, then we can option Big Blue and any other projects we might have. We might choose to option those to other parties. But until we have that big, game-changing drill hole, we want to be running a portfolio of projects. You never know which one's gonna end up being your winner.
No for option or for sale sign at Selena, though, I don't imagine, or I don't hope at least.
I don't have any projects in our portfolio that doesn't have a for sale sign on it. And I think that's an important thing to point out. We're running a business, right? Like, this isn't about getting attached to any one individual project. If a company approaches us and has a deal that we think is good for Ridgeline, good for its shareholders, and provides future upside, or immediately monetizes it too, we're absolutely going to consider it.
So that split, as I mentioned, kind of a hybrid company between an explorer and a project generator. How is the split in terms of spend going to be on this $2.2 million? What percentage goes into exploration versus project generation?
That's a good question. Probably right now, I'd say it's probably 60-40, 60% into our existing projects, Big Blue, Selena, and 40% into, and I mean, when we're talking about that 2.2 million, I mean, we're talking about maybe, $500,000 this year, 750,000 of that. It would be the actual pool of capital, right, that we would be allocating directly towards exploration. So we're pretty excited about the opportunities in Nevada. There's great porphyry and base metal opportunities still open for staking, and I think we'd be silly not to be putting stakes in the ground, right? Like, our team does that work ourselves. I think it builds value, and I think our team's had a good track record of taking early stage projects and showing that they have a lot of potential. So yeah, we're going to keep on doing that, and we're still very excited about Selena. But like I said, we're just kind of waiting for that permit to get approved. Once that permit's approved, we would then go out to the market and put out a press release and say, all right, permits are approved. Here's our plans for the year.
Is someone else knocking on your door, though, and saying, like, hey, if you have this permit for Selena, or when you have this permit for Selena, let me know and I'll come in as a partner? I suppose you're not going to be able to give me any specific, but is that something within the realm of possibility or happening right now?
Well, that's a big reason why we've really pushed this permit. And just for a little context, we've actually started the permitting process 2 years ago now, right? We saw what Selena was, we felt it had that potential, and it is a slow process in Nevada, right? It's pretty straightforward, but it takes time. And so we wanted to get that permit in because you're exactly right. Any big company, they don't want us, they don't want to option a project and then be like, oh, great, now we got to wait 2 years for a permit, right? They want to be able to hit the ground running. So we're trying to de-risk this project so that we can drill it, so that a partner can drill it. It doesn't matter, in our eyes. We want to see the project get drilled. And without that permit, it makes it really difficult. So that adds a lot of value for this project, is getting that permit across the door.
Okay. And then is there a timeline or something that you're working with? You're saying that, oh, I definitely want to have a partner for Selena by year X, whatever, 2025, 2026.
No, actually, it's kind of, we evaluate our projects a little differently. So when we talk about the hybrid approach, each project gets, at least a first stage of drilling, right? And for example, we did one stage of drilling at Swift, and we realized, oh man, this is really deep. It's very expensive. And as much as we love this project, it's too risky for us to keep advancing. So after one drill program, we went and found a partner. We're on drill program number 5 at Selena right now, right? And the project keeps on showing scale, keeps on showing good grade. And now we have this porphyry target that gets us really excited. So I wouldn't say in any way that we've earmarked Selena for sale or Big Blue for partnership either, right? It's just it's just every single project and every drill program, we have to go back, reassess, right? Okay, is it still as big as we thought? Is the grade and continuity there? Is the permitting an issue? Is the depth of drilling a problem, right? So that's something that we assess on every program. So to say that we have a set timeline for any of our projects to be optioned? I'd say no. It just entirely depends on how each drill program progresses, right? And then we take it from there.
How's the conversation progressing with Nevada gold mines? Like, are they not interested in becoming Nevada gold and copper mines, or like what?
Yeah. We've had chats about about other projects with NGM. We've showed them, they've come and looked at a couple of our copper projects as well. And they're really focused on putting money in the ground on the gold side. And for us, that's exciting for us, right? Those are deep projects. They're risky, but they got huge upside. So we don't want to also become, Nevada Gold Mines exploration arm either, right? Like they're great. We love working with them. Is it in our best interest or our shareholders to option every one of our projects over to Nevada Gold Mines? Probably not, right? So we're always, we got a great relationship with them. If we come up with something that gets them really excited, we kind of have a handshake agreement that we're going to bring it to them first, for them to at least take a look at. But there's no formal agreement or anything like that would require us to do deals on any of our other projects.
And again, as I mentioned, they're spending up to $5 million in related expenses to your company, biggest exploration company, biggest exploration spend in the company's history,
Yep.
as far as I'm aware. But yeah, no good. And I do want to talk about that here in a second, just before I forget, because we were really talking about deploying capital here within this, specifically within this last financing. Any plans for G&A increases, like more pay for management, more marketing, or something along those lines, or are you still going to be keeping it around sort of the $70,000 a month that you did last year?
It's going to be consistent. Yeah, there's no management, no significant management raises or bonuses or anything, of course, that are being paid out. Yeah, I'd say that our spend is going to be really consistent with last year, both on the marketing side and G&A. So
yeah, okay, fair enough. You also just recently walked the ground in Nevada. I saw a couple of good pictures. I saw why the property is called Big Blue, which is very,
yep.
very cool to see these blue rocks. Would anything new pop up to you while walking the bush, or anything changing based on that?
Yeah, it got us really excited. We were actually out walking Big Blue about 3 weeks ago, and there's two kind of big porphyry plugs that are on the project. One of them sits directly beneath the Delker mine, which is that main trend, and the other one sits over to the northwest, and it's this big mag high, and it's a Jurassic granodiorite porphyry just poking out of the valley. And we've walked that probably 2 or 3 times, and haven't ever really seen a whole lot of copper or like veining coming out of that Jurassic plug to the northwest. And then on our last walk, we, Mike and Gabe, our geos, they came across an old test pit with full of malachite, copper, quartz veining running through the granodiorite, which was a really significant change for us because we hadn't seen, you could say we weren't seeing the same level and strength of alteration and mineralization at that northwest plug that we had been seeing at the Delker mine, which is about 3 kilometers away. So yeah, that was a big development for us. It got us excited. And I think the IP, it's necessary to get an IP survey over both of those Jurassic porphyry zones. Make sure that we test them both.
Well, that's what you're doing as well this year. Oh, that's where that came from. That
Yeah,
doing that
it just got us really, it just got us excited because we were kind of doing the groundwork, talking about where we wanted to put the IP lines and stuff like that. And these guys, Mike and Gabe came across this test pit, actual real copper in it. It was significant for us because it shows considerably greater scale, right? You're seeing copper at, out in the valley, 3 kilometers away from the main mine site. So.
Yeah, there was also a very cool video of you mostly driving without hands, which kind of got me concerned.
Oh yeah, no, I have my truck has lane keep assist, so
I got that part.
I get a little bad at waving my arms around though.
No, I got that part. My dad always gets angry at me when I turn off the lane keep assist, because apparently it's supposed to keep you safe. So did it for you.
Yeah.
Anyways, how long do you think it's gonna take you to, once you do that? Well, let's maybe talk about timeline in general. Like, when do you do this 3D IP survey? How long is it gonna take you to do it, and how long is it gonna take you to analyze it and come up with any conclusion based on it?
Yeah, so we really couldn't start formal bidding too much process with geophysical providers until we kind of closed the financing, because none of them were willing to really talk to you until you were willing to write a check, right? So now that we're financed, we're ready to go. We're hoping to get a survey out and going probably late June, early July. Doesn't take very long to process that data. So certainly I think by the end of July, we're going to have our full process data set ready to go. And that'll allow us to start, once we have that we already have permits in place at Big Blue, if we have to do any modifications and stuff like that. But it allows us to start thinking about what would a drill program look like in the fall if we were going to move forward.
Oh, okay. So basically what's starting the end of June is where
Yep.
news is really going to pick up
and
okay.
That'll pick up. Big Blue news will be end of June all the way through, into early August, probably, as far as kind of, the IP survey and what we plan to do from it. And then, Selena, we're going to see hopefully that approval in late June, into July, for the permit as well. So I think as we start from June all the way into the fall, we're going to start seeing a lot more news flow for the company. Not to mention that doesn't even include Nevada Gold Mines starting the drill program, which is anticipated in late June as well.
Okay, so do you know what they're going to start with? Are they starting on Swift?
Yeah, so they're going to start with it's going to be a 3 to 5 hole program, still focused on working in the 2 primary areas that we've drilled in the past, Southwest Swift and Mill Creek. And yeah, they're going to be following up on positive drill results from 2022, where we had up to 48 meters, a half a gram per ton gold, which is significant, right? That's a large area of low grade gold showing a strong hydrothermal gold system. What they need to do now is try to get into some of these structural traps where the right host rocks are getting folded up and bunched up along these fault zones. And that's where you're going to start seeing hopefully some higher grades. So they'll be going in mid June to late June. And that program is going to take most of the year, right? We're talking about, each drill hole takes upwards of 6 weeks to complete, right? These are deep drill holes.
How deep is that? I mean, yeah, too long.
Yeah, they have the ability to drill up to 1,500 meters pretty comfortably. Yeah.
Those are $1 million holes, right?
Give or take. Yes. Yeah. So
Wow.
when we talk, the 5 million budget, 3 to 5 holes, that's what pulls that all together.
Okay. What about news flow from that, though? I mean, they are dictating the pace of it, I suppose. But what's material for you might not be material for them. How do you manage that?
Well, they've been truly fantastic partners to work with. Like a lot of majors, they're very tight with their data. They don't like to share information. That's just kind of the way the business works. We've never had that experience with NGM. Part of our agreement was until NGM spends the minimum $20 million to earn 60%, Ridgeline's the 100% owner of this project, right? And everything that they do is essentially material. So as data comes in every 2 to 3 months, we're able to assess, how material is this? And if we choose we want to do a press release, we have to give a week's notice to NGM. They've been great to work with as far as, crafting and writing the PRs with us. And we'll put out the news.
Okay. And that's well, then essentially all of the money that they're going to spend, yeah, or virtually all the money, almost all the money is going to go into Swift. And what do they need? Like $5 million for it, you said?
Yeah, I think 5.2 is the total budget across both projects, of which 5 is going to be spent at Swift. Black Ridge, they're doing prospecting, mapping, additional geophysics if required to kind of refine some of these deeper targets. And they're pretty much just preparing Black Ridge for what they would consider a maiden drill program. We've already drilled a couple holes out there. Had a tough time getting the holes down to depth. We drilled, I think, almost a 1,300 meter hole there in 2021, which was very expensive and stressful, but it proved the general geologic model, which brought NGM in 2023. So the majority of the money is going in the ground at Swift, which I think is phenomenal. If the full spend is completed across both projects this year, it'll be about 13.5 million US spent across all of our partner projects since the fall of 2021. I mean, to me, that's incredible. That shows that our business model is working, right? We're advancing our own projects. In that time frame, we've shown that Selena has potential to be a pretty significant CRD discovery, while also having our partners put 13.5 million in the ground. I think that's a huge win for us, and it reduces dilution while still keeping us engaged in the projects.
There's no obligation for them, though, right, to spend as much money, or is it?
They only had to spend 4. So NGM had to spend 4 million in the first 2 years of the deal at Swift. And so that would have been by end of 2023, they had to spend 4 million US. They spent 5 million by the end of 2023. Well, actually, no, sorry, closer to 7 million by the end of 2023. So yeah, they've been pretty aggressive. I think they want to see a discovery in the Cortez district as badly as we do. So.
But then Black Ridge, because you say they're aggressive. They've been aggressive on Swift, obviously, and this also proves it with these $1 million plus holes. Is it realistic to expect Black Ridge to get drilled next year or later this year? Because I know it's year-round drilling technically, But what do you
No,
think?
actually, you'd be surprised. It's very high elevation. So the top of our
Okay.
project is over 2,500 meters high, almost 3,000 meters in certain spots. So it gets up to 10, 15 feet of snow. So in the middle of the winter, it's not really accessible. But yeah, they have $1.5 million guaranteed spend that they have to spend by the end of 2024, by the end of 2025. So sorry, by July of 2025, my mistake. So, they'll have spent around $500,000 by the end of 2024. So there's $1 million that needs to be spent in the first half of next year. They can choose how they want to allocate that capital, but I would guess it'd be with a drill bit.
Right. Do you know where on the property they're going on Black Ridge specifically to do this geochem?
Yeah, actually, they're kind of blanketing the entire project. So any areas that we didn't get filled out while Ridgeline was operating the project, they're just pretty much filling it in. So it's 17 square kilometers, so it's a pretty significant program that they're doing.
Right. Okay. Good. Well, so yeah, this gives me an overview. Sounds like there's going to be just what news flow between now and the end of the year. What are you expecting? So every month or so, you expecting to have at least a news flow?
I'm hoping that I'm going to have a material update for one of our projects every 3 to 4 weeks, all the way through the end of the year. Yeah.
Good.
Yeah.
Good. Or are you thinking the money that you have right now, the way you explained it to me, it sounded like it should cover you until the end of the year. But then if you want to, I mean, if you want to do something at Selena, then you're going to have to do another capital raise, I suppose.
Yeah, sure. So the budget we have right now, we'd be comfortable through first quarter of next year of 2025, just as far as like keeping the G&A, and keeping the lights on. If we want to go drill Big Blue, a significant program at Big Blue or a significant program at Selena, we'd have to do another capital raise. But the strategy behind that is I didn't want to raise 4 million or 5 million at 12 cents, right? Far too dilutive. People would have been happy to write checks, I think, at that valuation, but I think it would have been too dilutive. So if we want to do significantly more exploration in call it the fourth quarter of this year, we would just have to do a raise, hopefully at a better valuation. I think we're already up almost 60% from our when we closed our financing. So yeah, we'd like to get that stock price up and keep dilution low.
Well, that's interesting. That, by the way, that last thing that you mentioned, because it seems like it's kind of a trend very recently, like the last month, maybe month and a half, where we see oversubscribed financings and the stock goes up on the news that it would typically have gone down had this been like last year at the same time.
Sure.
What do you make of this?
When we first announced, like I said, we weren't sure, is this an actual bull run? Like, are we seeing an actual shift in the markets? Or is this just another kind of, little blip and we're going to be right back to the nightmare that was 2023? And it does feel like, I think the response we've seen, I've had so many retail shareholders reach out and say, hey, I was waiting on initiating a position until you actually secured a financing so I could be sure you weren't going to run out of cash. And so we're seeing, like, for me, I think that's a big sign that we're actually into an actual true shift in the markets, and things are going to start improving through, hopefully, the rest of the year. I think when you're seeing the retail folks taking meaningful chunks, I think everybody's been so gaslit for so long that to see folks putting serious money into a stock like ours, a little micro cap, I think it shows that things are going to get a lot better, hopefully, through the year.
Well, I hope you and Rickroll are both right on this, but it'll be interesting to follow along. Thank you, Chad. I really do. I like what you're doing. I think you're doing everything right, trying to do everything right. There's obviously always risk, geological risk financing, all these things, but I really appreciate seeing younger people like yourself trying to do everything right in this space where most of the stuff is done the opposite of right, whatever that might be. But I appreciate that, and I appreciate the update
No
here.
comment, but I appreciate it.
Thank you so much for this update. Anything I'm forgetting to ask you, though? Anything else you want to add here at the end?
I think anyone that's interested in learning more about the company, I'm a pretty open book. My personal information is on all of our press releases. You can find my email, cpeters@ridgelineminerals.com, on our website. If you want to learn more, I'd encourage you to reach out directly to me, and we'll set up a Zoom call and I'll walk you through it.
Yes, and again, as I said, Chad, I do appreciate that. Thank you again for being here. I'm looking forward to our next conversation, hopefully soon. Hopefully more updates there. But I'll let you drop off now, as I'll be traveling to South America, Chile in particular, where I'll revisit with Sean Wallace, who's going to be telling me about what's happening with Torq Resources, which also, as mentioned earlier, is paying for the production of this interview. The company is listed as Torq, so that'd be TORQ on the TSX Ventures Exchange, where an average of about 140,000 shares trade each day, with a 52-week high of 61 cents and a 52-week low of 9 cents. with a market cap of about $15 million and about 134 million shares outstanding. Today, this is an 11-cent stock. I'm seeing 7.5 million options at an average of 73 cents per option. There are about 45 million warrants at different prices ranging from 23 cents to about $1.10. And so with that added to the shares outstanding, it brings us to about 186 million fully diluted shares. About 12% of the company is owned by management and insiders, and after the recent financing, about 15.5% of it is owned by Goldfields. Looking at the latest balance sheet, which is dated March 31st, the company had $2.8 million in current assets, most of which, $2.3 million to be specific, was in cash, with a $500,000 prepaid expense on top of that. Accounts payable and accrued liabilities came in at over $2.5 million, though, and the loan facility, which we'll discuss later on, has now been somewhat amended, and so it's still on the books at just over $2 million for total liabilities of 4.6 here. That same financial statement also tells me that on average, over the last reported 3 months, Torq Resources spent about $300,000 a month on administrative expenses, which is about 50% lower than what they had recorded for G&A during the same period of last year. Whereas the exploration and evaluation expense came in at about the same amount as the same period of last year, that being specifically $1.1 million a month. To put it simply, though, that means excluding share-based payments and also an impairment on a property, and I'm also rounding up, of course, the company spent about $1.5 million a month on average over the last reported 3 months, about 80% of which went into exploration and evaluation, so a little over 20% went into G&A. As it always is, though, and as it always will be, this financial statement is only a snapshot in time, in this case specifically at the end of March of this year, and the finances will have changed by the time you're watching this. So please do head over to the company's website, as well as setterplus.ca, to look at the numbers yourself to make sure you're getting the full picture, especially because as it is with most of these companies I talk to, this is a non-revenue generating company. They rely on the public markets for financings, and there have been financing activities since this statement was published. So again, your responsibility to double check the numbers and figure out what's actually happening. That all said, no 10-minute company overview here today, because Sean and I actually did a deep dive on the company a few months ago, which I'll list in the description of this video. So go and watch that for a more in-depth overview of the company. But in a nutshell, there are 2 copper-gold exploration projects in Torq's portfolio. Both are in Chile, but they are on separate mineral belts. One is sort of east of the center of the country, if you will, in the middle of the coastal Cordillera belt. This one is called Margarita. And Margarita is an IOCG-style target with a discovery on it with highlight drill results of up to 90 meters of almost 1% copper and 0.84 grams per ton gold, and 98 meters of 0.94 grams per ton of gold and 0.7% of copper. And then the project on the other side is to the southwest from Margarita on the Maricunga belt, and it's called Santa Cecilia, where, by the way, recent drilling has made a discovery showing 120 meters of 1.3 grams of gold per ton, as well as some copper and a little under 0.01% of copper that came back on the back of drilling of the first hole, actually, earlier this year, where the discovery was made. So that was 502 meters of 0.3 grams, 0.36, not 0.3, wait, so 0.36, almost 0.4 grams of gold that came back, as well as some copper. Again, not a lot of copper, but there was that gold there. And according to the company, this was confirming the porphyry-style mineralization that they're after at that belt. So something that I hope we can discuss later on. So again, limited overview here, because Sean, I'm rushing to start the interview as since you and I spoke, things have not been going too well with the capital markets and with the stock price specifically. And although on the project level, once you start looking into these things, they look promising, maybe not based on the public's perception, things, again, may not look like they're going too well. So I suppose there's really one main question here, maybe a multifaceted one, but how do you, as a junior in this situation, we have to keep drilling to keep the market excited, but it's also not cheap. It's expensive to raise capital. How do you fix this? And where do you go from here?
Yeah, well, there's a couple of ways you can attack it, and we're doing it from every possible angle. One of them is to reduce your spending. Obviously, if when capital is so dear, both in what it costs your current shareholders in terms of dilution and fees and so forth, and filing fees and accountants and all the other stuff that you have to do when you gear up to do a financing. That's why we elected with this latest financing to simply do a private placement. It wasn't worth the extra cost of doing like a bought deal structure for such a small amount of money. And we're just raising money for G&A, so we didn't, and really the stock has fallen outside of the goalposts, if you will, where the institutional shareholders would take it up primarily, and that is usually the driver for why you have to do these free trading instruments. We went with a PP, but in the bigger sense of things, this project is sort of the right project at the wrong time. This project requires a lot of capital, and we knew that getting into it. That's why we structured the deal the way we did. We just couldn't have known. We didn't know. We didn't bet on things going as poorly for as long in terms of the capital markets appreciation for these little micro cap gold and copper exploration companies. All of that juxtaposed against the fact that we've had fantastic exploration results with the meager sort of amounts of money that we've gone out with, which really don't do a project like Santa Cecilia justice. That's why when people generally look at one of these things, it's sort of a bull market for a junior asset or a majors asset. To be able to, have that sustained capital. And as you pointed out, we're not revenue generating. So we don't have, like major or mid-tier companies, the benefit of being able to draw from metal being sold into these high metal prices that we're all witnessing and enjoying, some enjoying more than others, frankly. The high metal prices haven't sparked a sort of rush to speculative sort of activity. And that's really the lifeblood of what we do. We're exploration. So we have a premise or a concept, and we go out with a diamond drill, and with scientists, we try to prove that. And there's not a lot of appetite right now for that sort of thing. So how do we do it? We have to look creatively at it. We have to cut our costs. We have to, I personally don't take a salary anymore. Don't want to dilute the company for that. So my job costs me money. I'm going to be subscribing heavily into the latest financing, and I'm happy to do so. And why I'm happy to do so is because of the quality of the assets. I've done this for 35 years, and I know if we just stay here and keep supporting, keep doing the right things, that one day the value of these assets will translate into the share price. That's the opportunity. It's turning to be a great opportunity for patient people, not so much for anyone who's looking to trade or to realize a gain in any prescribed period of time. The other things we can do is look outside the box of how we traditionally finance these things. All sorts of different structures. You could do an asset level deal as opposed to selling your stock. You could, talk to major mining companies about perhaps partnering with them to have them earn an interest in one of the assets for capital as opposed to diluting the company. So we can go down those roads. We've also taken this opportunity to speak with our underlying owners, both at Margarita and Santa Cecilia, about renegotiating the property timetables. That's both the cash payments due and the work commitment. Fortunately for us, we're in a good place to have these conversations because come hell or high water, we managed to keep these assets in good standing. They're in good standing. In fact, we're ahead on our spend in the ground on both assets, and we're right on schedule with any underlying cash payments. So when you have a good relationship with the underlying owners, you can get some forbearance from them for a period of time. What we're trying to negotiate is simply a holiday for a 12-month holiday, kind of take off that obligation, that sort of gun to your head that you must go out and work in a market that doesn't care, or you must make these payments in order to keep the assets whole. Frankly, you've seen some movement on the personnel in our company as well. When we went to a not paying structure for executives, some people were unable or unwilling to do that, and so that's where you've seen some turnover there. People that remain with the company now are people who are behaving like owners. When you're an owner, you don't put your personal need for salary ahead of what the company needs. And frankly, we're all expendable. What Torq shareholders need to realize is that we're focused on keeping the assets whole, because that is what ultimately is going to pay everybody. So those are the ways to try and to battle your way through this, and that's precisely what we're doing.
There's two main things that I wanted to touch upon here from your answer. One of it being G&A, and the other one that you said, look outside the box. Let's do the G&A thing first. As I mentioned, relative to the same period of last year, based on that last report, you spent about 50% less money this year than last year. Is there a place for,
Oh
I
yeah.
mean, you're still at about 300 grand a month. How much are you targeting for this year? Is there room to lower that?
No, that number is I've got it down to about 150 now.
Okay.
We finished our big drill program at Santa Cecilia. That bulked up G&A a little bit. We've gotten rid of our office here in Vancouver. That takes effect here in the next couple of months. Obviously, when you move an office space, you got to sublet it. There's a process. But we have successfully signed a lease for our office space. We've reduced the number of people in Vancouver, so we don't even require office space. We have shared offices that we can use, sort of like just for better lack of a better description, like a WeWorks type thing where we can go in and utilize it when we need to, but we don't even really need to that much. All of that in service of maintaining where our core business actually exists. That's in Chile. Chile is where the projects are. Chile is where the think tank, the professional think tank, really in terms of the science behind what we're trying the theories we're trying to prove, that there's an economic deposit at these two projects. Ultimately, that's what we're trying to through our activity, demonstrate, put it out to the market, to the other major mining companies, to evoke a transaction that will be accretive for all stakeholders. And so we know where the financial energy needs to be in order to move this thing forward, albeit on a sort of suboptimal rate cadence.
Well, you mentioned, what I'm thinking here is, like, typically I would ask, like, what do you think the market is missing? But actually here, we could maybe think about, if the market is missing this, but you like what you're seeing in the geology, why not go and talk to, you have a large company as a shareholder. There's other companies active in this region. Why not go and talk to those companies and ask them, hey, do you like this? Because the rocks are checking out. The market's not appreciating that. Let us do an asset level deal. So instead of equity dilution, you think what people call asset dilution to sort of help you move it forward, because, some percentage, whatever that might be, 50, 30, whatever percentage of something is better than 100% of nothing, which it would be if you have no money, right? So is that something you would consider when you say you look outside the box?
Yeah, I mean, more than consider. Frankly, that is a concept that we're embracing wholeheartedly right now, and we're having numerous discussions along those lines. So it's interesting that you found that that idea sort of jumps out at you, right? I mean, at the end of the day, that's a mathematical exercise. Sometimes real speculators don't like that because they feel you've given up some of the upside by selling it at the asset level. That's obviously a valid argument, but there are no speculators in our market right now to buoy it and allow us to do it ourselves. So in absence of, we don't really need to consider that perspective. We need to consider the perspective of how you create value, and value is what you get paid for ultimately, all things being equal. So if you dilute at the asset level, you own, like you said, I'd rather own 50% or 25% or whatever percentage you end up being remaining after you fully realize the value of the asset through the exploration process. If you're, what would our current shareholders be left with if, say, I raised, $50 million over the next 5 years for Santa Cecilia? Well, it would dilute all the assets in the company. It would dilute the shareholders. But if you do an asset level deal, yes, you would lose that percentage. You sell that, you trade that percentage, if you will, for the capital in the ground that you don't have to spend, and you're left with just pure upside, and you don't have that financial pressure. I think it would give the stock room to breathe. It would allow the exploration activities to go unfettered, and there's all sorts of reasons why you need that to happen. We're dealing with people here with a community that we made commitments to, that we would be there and we would work and we provide benefits. When you're not properly financed, you can't deliver on those promises. And we were genuine in making those promises. We intend on keeping those promises. So we have to find a way to do that. And those are important promises to keep. We're foreigners, we're guests in their country. We through negotiation and getting to know one another, and we spent a great deal of energy and effort doing so. We came to a really good place with the community. We currently have an amazing, relationship with them. They're very supportive. We provide employment. They provide the opportunity to be there in the first place. So there's a lot of aspects to this that are extremely important to the viability and the sustainability of the project, that maybe aren't readily apparent when someone just looks at a share price, say, oh, the stock's down today, something must be bad. It's really not that simple.
No, well, market conditions again come to mind, and what we're talking about here. You need to find someone who recognizes this basically as a CEO, because like if you're out there and you're looking for retail or institutional investors to recognize it, but they don't in this market, and maybe you go and look the other upstream as they call it, or whatever it might be. So
Yes.
interesting
I can
idea
tell you
there.
the major mining companies definitely understand the significance of what's happening here.
So they're coming and looking, or like,
Yeah, I mean, yeah, obviously when you do this stuff, you do it under CA. I can't talk too much about it, but I can tell you that we're currently in advanced discussions
right.
on this concept.
Okay. That's interesting. And in the meantime, you have now with this raise, you have enough money to cover how long of a runway?
Yeah, it's depending how things go, what activities we choose to maintain during this time, but we could last several months with this G&A financing we're doing presently.
Okay, several.
None of this money is earmarked for to drill holes. It's again, none of the executives in Canada are taking any sort of salary. Now that the Santa Cecilia drill program's done, we've sort of been able to reduce that workforce because we're not active. So and that's normal. Typically for junior mining, you staff up for a program, and then so those costs, which are reflected in the financials you were mentioning, all that burn's going to go way down. The only sort of activities we need to maintain would be baseline environmental work, some community work, and just some permitting work. So not terribly expensive, but terribly important. So we're not going to curtail those expenditures, because that could have a very deleterious impact down the road when you do get properly financed and you're good to go. You don't want to be, oh well, we decided to defer permitting and now we've got to wait a year to get a permit because we didn't have the foresight to know that you don't create bottlenecks for yourself like that.
Sure. When you say several months, are we talking like 2, or is this more in the realm of 6 months type of thing?
Yeah, I think it would give us 4 months, 5 months, and not enough to get us. And again, I said there's a bunch of variables so I don't want to talk with precision here, because there are things that you can't see coming and things that come up invariably in any sort of scenario they do. But we have a good handle on the stuff we do have a handle on. And if I went down to a zero activity, we could last to the end of the year.
Okay.
But I don't envision that. I envision us being successful in some of these conversations we're having, getting this thing adequately financed, getting back to work, and having, creating some room for the stock to breathe, creating data through the activity that will help turn this market around and get people to realize the true value of what we're seeing unfolding here at Santa Cecilia, particularly with the results from the last drill program.
Which we are going to talk about for sure later on. Why I'm asking about how long of a runway is because I'm also thinking about, I made a note to ask you about that loan facility that you've now kind of, well, not restructured, should I say restructured? But it's essentially...
It was extended for a year, so the due date on it.
Okay.
Yeah,
But
so we still pay the interest. We still pay the interest, but it's not something, again, it's took the barrel of the gun away from the side of our head on that one as well, just as we did with the other expenditures. Give time for things for us to get some momentum in the story, some financial momentum in the story, and then that debt's held by a very friendly supporter.
Is it someone like within the company or?
No, we have to disclose that. It's with a third party, but a third party who we've done business with all the companies that Ivan and I have created over the last several years.
Okay. And it's why I really wanted to bring it up is because you are indeed sort of deferring it, but that's also going to cost you. And you say that it's estimated, an estimated interest rate of what, 30% is what the financials say. What is, I mean, this is
not
getting
30%, it's 10%.
Yeah, but the financials said that,
well,
I suppose that's a total interest that you're going to pay on it, or something along those lines. Because when I looked at the financials, it said an estimated interest rate of 30%. I think I can pull it up right now. But
Yeah, I don't have that in front of me right now. It's definitely not 30%.
Okay, because is it getting more expensive? Basically, is what I'm asking to
Well, I
amend.
think the reason that you see that 30% is because with those loan facilities, you give warrants with so with all the confusing accounting that has to happen with the regulators require, it really values things. It's kind of like when they show executive compensation, you got some stock options that are, way out of the money, but it shows that you got paid $1 million last year. I can tell you that's simply not the case. I'm not saying that on Torq. I'm saying I've ran into this before. Just the way you have to account for things in public companies often make things look more inflated than the reality.
Okay, so the 30% wouldn't be an out of
It's
pocket
10%.
cost,
It's
and
10%.
right. So
Real cash, 10%.
okay, sure.
Yeah.
But you when you say that you have a couple of months of runway, you're including keeping that in good standing as well, I assume.
Of course. Yes.
Okay,
Yeah,
good.
yeah, of course. Yeah, no, keeping that not in good state is not an option either.
Right. Yeah, that's
Yeah.
what I'm asking about it. But good, that's fine. Let's talk about this recent. It's a new discovery that you call success with the drill bit. That again, we're talking about that the market is not necessarily recognizing it. And let's maybe take it sort of from the top as to the why of it all. Like, why did you even go and drill this in the first place? Because I don't think this was initially your priority target. It kind of changed over time. But so why drill this in the first place?
Well, we did it because we really wanted, there's something with the permitting on the Pircus Norte. For one, it was a high priority target for us. I think maybe when we talked last time, we were going to step out again in Cerro del Medio in search of the causative intrusion that we know will be there. But down at Pircus Norte, there is, we're working on things called a DIA. Right now we have a permit to do like 40, 50 platforms in various places that we can drill from. But we wanted to find out at Pircus Norte if it was worth going for including that in the DIA. And so most certainly, excuse me, you can see from the results that it will be getting included. And I'm glad we chose to do it that way. We only had enough capital to drill 1,500 meters. So that's what we did. And we didn't drill as deep as we want. If you look at the 2 discovery holes at Pircus, they both ended in the very best mineralization. So we left the casing in so we can go drill them deeper. They most absolutely have to be drilled deeper. Those holes were also drilled on an angle from way off. So the depth, if you look at it on section, and those sections are in the news release, I would really ask people to go look at the section, because that will tell you the story. Now that we know the quartz diorite and the porphyry diorite rock type, the one that carries this grade, that last 120 meters, that's going to go a lot deeper. That's going to carry on. And there's also places that once we have the DIA, we can drill it vertically and get a real sense of how close to surface it is. But that looked artificially deep because of having to come at it from an angle. And I can sit here and spin all these words, but it's better if you look at the picture, then you'll immediately understand what I'm talking about.
Right.
So the point being, that discovery is incredible. We always said, okay, so you get a project like Santa Cecilia, and I've worked on projects like this many times in my career, and there's this wall of doubt. Oh, it's a big sea of low grade, and certainly I can see why people would say that. But the people who are stewarding the opportunity, the technical people and the financial people like myself, you have to believe, you have to understand these systems. You have to know that if you stick to it, you're going to find that better grade. And I've been saying that and saying that. But particularly in a non-risk environment like we're in right now, no one's going to ever listen until you actually do it. We've done it. So I think we can build on that now. That 1.33 grams, that in a porphyry plus a 0.1 copper with it, that's what you need. That's called ore. And if I'm being cynical and talk about, how an engineer in a major mining company looks at rocks, they don't get all worried about this one or that one or the sparkly this or that. The way an accountant looks at it, the way someone who isn't a hopeless dreamer like we geologists are, it says there's only 2 types of rock: waste and ore. And the good news about in a porphyry system, when you start finding the ore, if it's rich enough, if it's good enough, it can convert stuff that looked like waste into ore as well. Because obviously with the geometry of an open pit, you're going to mine out into that lower grade stuff, and you're mining basically the average grade of the deposit at that point. It brings it up with kind of the bell curve, if you want to talk about, once you have those causative intrusions. the great thing about Pyrrhus too is we don't feel we've, like, even though we found that grade, we're not convinced that that is the causative intrusion. So we also feel that there's still even better stuff to come there, which is really exciting.
I suppose, or well, I shouldn't suppose, but I should better ask you if the major players will look at this in sort of a comparison situation, like look at what's around you and say like, oh, could this be an extension of X? In your case, that would be Caspice, I believe. So
PJ would be the best analog. It's in the same. It's the same geological event. It's in the controls are we're finding it being the same rock types. Fortunately, that's a very mature project, so there's a lot of public data in terms of technical reports and so forth. And we've got people who work with us that have worked there previously, so we have that firsthand knowledge of how that evolved and for them. And so we're seeing, yeah, it's pretty exciting. We're seeing all the right things. We know we're on it. It's just a matter of getting up there with $20 million and drilling and not having to stop and finance, explain. And if I could drill 10 more holes, you and I could be having a much different conversation right now.
yeah, it goes back to the discussion sort of at the beginning of the video, like how do you do it financially? So again, yeah, that would be the main point. Interesting about Caspice, because it's kind of dangerous making those comparisons, I suppose, because someone can look at this and say, "Oh, there's a bit of hopium here going on," right? Because I mean, there's a huge deposit, and everyone would like to look like it. Why would this actually be the case? So talk to me maybe a little bit more specifically about the comparison here. Like, are you seeing the same alteration footprint? Is the mineralization distributed in the same way? Like, what are you seeing?
Yeah, particularly over at Serra del Medio. When we spoke last time, we deep dove on it. That was the only drill data we had. And as we go, we actually use the alteration vectoring that they used at Caspice. So there's a slide in our corporate presentation that illustrates this beautifully. And on our side, it's a bit of a cartoon. We've drawn in where we think the causative intrusion will be. But the reason is that when the underlying owner drilled that first hole, the hole that predicated our whole acquisition of the asset, that 925 meters, 0.5%. Okay, is that ore? No. Could it be ore? Yes, coupled with the right high grade core. So we stepped out 700 meters. We increased the gold grade by 80%. But what's important, and what obviously is lost on generalists or retail investors, you can't expect them. They don't all go to university for 4 years to understand these things. Is the alteration, the rock types, all these little signs, when you go compare it to Caspice's drilling that went peripheral to their causative intrusion, as it vectored towards the intrusion, you're seeing the exact same thing happening in our rocks. And again, you would expect that. So when we get to our causative intrusion, will the grade be as good as theirs? You don't know. You have to drill it. Could it be better? It absolutely could be better. It could also be worse. We don't know. All we know is you must drill it.
But you're assuming it's a different causative intrusion. Like you're assuming.
No. Well, every porphyry has its own causative intrusion.
Okay. So
there's not one of them for the whole region. Every deposit, that's how these little deposits occur. There's this intrusion that comes up and it blows all the metal into the host rock. And there's your, in a very simplistic way, there's your deposit. Okay. Within that deposit, as you get away from that heat source where that came up, obviously the grade gets more disseminated. So closer to it, obviously, is where it's going to hang together. And the different metals move differently. In other words, copper and gold have the different weights. So they to keep it really simple, they disseminate differently, but they disseminate together. So you're going to have more gold-rich zones, more copper-rich zones, and so on and so forth. Now, these assets are definitely, Caspice is a gold-copper deposit, and San Cecilia is going to be a gold-copper deposit. Cerro Casale, gold-copper, not copper-gold, gold-copper.
What do you? It's interesting that you say that they're definitely separate intrusions. Like, so you're already assuming, or you already know that this is not going to be a continuation of Caspice. It just can be sort of a lookalike. Is that what you're saying?
It's a continuation insofar as it all happened at the same time when the planets were formed, when the rocks were forming, and all the tectonic activity that was making this happen. It happened at the exact same time. And maybe if you took the We don't drill down 10,000 meters into the earth or whatever it would take to see where this all might have come from the same spot on one massive intrusion. Then it's splintered out into separate intrusions. But these big porphyry camps, you often see that. I've worked on a number of projects before that became mines, where you found one porphyry and then over 5 kilometers this way was another intrusion. But it came as part of the same geological event. So it's, there's 100 different ways to describe this. What's important is it's all occurring in the same way. So it's not a continuation of necessarily, but it's a continuation of the same geological event spread over a large area. Same age, same alteration system, same scientific factors that are the genesis of the deposit.
So the mineralizing event would also essentially have had the same strength as what you're assuming, and then if you have the same host rocks, it could have mineralized them in pretty much the same exact way.
Yeah, or similar.
Similar.
One might be slightly richer, some might, again, this is this thing. The only way you get an answer to that is by drilling holes. The only way.
Well, it sounds like I know what I'm talking about, which I don't. I just read the sort of the detailed description of your news release, and there's a couple of things that I come up with from there. In part of it, you also mentioned that there's an absence of epithermal indicators at Pircas Norte, and they suggest easier access to the porphyry system. What does that mean? How would that work?
Well, over at Cerro del Medio, there's an epithermal system on top of the porphyry. At Pircas, there is no epithermal system on top obscuring the porphyry. So the porphyry actually daylights at Pircas Norte, where it doesn't daylight at Cerro del Medio because it's got this epithermal cap on it. So essentially that's the difference. So the porphyry, but the good news about it, Cerro del Medio, is that epithermal cap is completely mineralized and there's probably 1 million or 2 ounces of gold in it. So if it comes to a mining scenario, you're probably do some sort of oxide mine on that. A lot of it's weathered and so on and so forth. I mean, we've drilled 5-6 holes on this, and for heaven's sake, we're not really quite engineering those holes yet.
Okay. Yeah, well, it is early days for
premature.
Sure. You also, in that same news release, you also did talk about logistical limitations, is what I can read in there. What does that mean specifically? What's happening? How does that look like?
So we drilled, there are logistical limitations. We had two logistical limitations on the last drill program, one being capital, and second being where we could set up the drill. There's an area around Pircas Norte that we have to get permitted, so we had to step back and drill on an angle to hit our target. So that's all. So all it means is we weren't allowed to drill a vertical hole right down the guts of what we wanted to. We will get there one day. It doesn't matter. We're getting lots of good information by drilling in on the angle. In fact, it also tells you how the different rock types correlate. And you would have drilled those holes in any event. We're just in order to say, okay, this porphyry starts 10 meters down. Well, actually, in fact, at if you don't know those holes, we did have some good stuff right at the very top, and then there was an intrusion that came in before we got into those diorites where it really started to get interesting. The last 30% of the hole or so is where things start to get really happy, and that's where we ended both holes in that mineralization. So who's to say? It could go for another 1,000 meters, it could go for another 10 meters, it could go. We suspect that it's going to go for quite a distance, though, not more towards the 1,000 than the 10. But again, I'm speculating, but just having a lot of experience with these type of systems and seeing the kind of widths that you're seeing on both Cerro del Medio, at Caspiche, how these things are, that's what's happening elsewhere. It would be in the similar geological events. Why wouldn't you assume that's what's going to happen? I mean, that's what you have to do. You have to use the data you have to extrapolate and say, okay, this is what we might expect. And then you drill the hole and see if you're right or not. And then you get another piece of data to add to the thing so you can extrapolate your next idea. And so on and so forth. Until you have enough data that you got it all figured out. And hopefully at that point you can say, I've got an economic project that someone would like to buy. Or build.
How I wanted to ask you, and I might ask you this later on, but that wouldn't really fit here. What I'm thinking about is, that's why we have forward-looking statements. That's what I wrote down. But you mentioned you know, the last 30% of those holes, this hole 5, it ended with coarse visible gold. What are the implications of that? Like, well, what's that telling you about the system here?
You know, that happens sometimes in these porphyries. That's definitely not the type. We're not out there hoping to find gold. Sometimes, you know, it accumulates like that. We got polymetallic veins, so you'd probably see that molybdenum and some of those other elements would be elevated in those zones too. Again, you know, you got to take the big picture on this thing. Sure, it's great to have some high grade gold there that's helping to contribute. That tells you that, okay, there's problem. It's not nuggety though, so that's good. In other words, on like gold systems, you have nuggety effect, and that's not necessarily, you know, we top cut this stuff when we're putting in the average, so it doesn't obscure what the actual result is over the average. You know, people. So what's really important? Yes, the good grade, awesome. But I'm there. I'd rather see the, you know, hundreds and hundreds of meters of the gram plus than have this odd 50-gram thing. I mean, we're not going for an underground mine here, so we're not hunting grade like that. If I was on a greenstone belt, you know, somewhere in the Abitibi or Africa or in the Arctic of Canada, then I'm looking for that 50-gram stuff all day long. But I much prefer this porphyry mineralization, big open pit, modern mining, not trying to find something good enough for underground, because I'll tell you that business is getting tough.
It seems like every business is getting tough out there.
Well, there's no doubt about that.
But that's maybe a different point. So what else is happening this no, but let's maybe theoretically. I know it is in the theoretical realm because again of the money thing that we talked about at the beginning, but how do you ideally, in an ideal world, how do you follow this up?
Yeah, well, let's just not talk about if I had my way, we'd go up there with you know, I could justify easily a $20 million spend up there and for a next phase, and with at least 3 drills if you could, because I can tell you the capital efficiency gets a whole lot better with more drills. So when you mobilize a camp, when you get all the people up there, okay, that is a fixed cost, and some of that stuff is going to be, if you add another drill, you get twice as much core, but it doesn't cost twice as much. It costs maybe 10% more, other than the straight drilling meter costs, right? All the ancillary costs, all the support costs. So you still only need one medic there. You still only need one mess hall. You still only need just a bit more food with a second drill crew. You don't need that many more geologists. You don't need, right? So more drills equals lower per meter drill costs, which
Yeah.
means more that capital gives you more of an opportunity to deliver a result that might change your fortune.
So do you necessarily go deeper here? Like, can you warrant that from a risk reward perspective, even if money was free?
Well, you go where the mineralization takes you. I mean, I'm not going to drill a 10,000 meter deep hole. I'm being absurd to make a point because no one's going to mine down there. But you sure, I mean, you look at some of the like ATAC and the Lundins with Philo, they're drilling, you know, a couple kilometer long holes. And ATAC's, their mineralization starts at 1,200 meters. So they're drilling, you know, all the low hanging fruit on this planet has been pretty much picked. So the sort of the deposits that are just sticking out of the ground saying, come mine me, or they're all mined or being mined. You know, so even on our angle, ours started at 300 and some meters, which that's not the true depth. It'll be higher up than that. It'll be a couple hundred and some meters maybe, or who knows, you know, we'll find out, but it will definitely be higher up in places. And that's not deep in a modern context at all. So when I drill it, the drill bit's going to tell you, you get into the right rock units, you start understanding what it is. If it looks like you're in some great grade, you let that drill keep going. You'd be crazy not to.
Yeah, of course. And again, thinking about sort of the timeline in relation to the money, because that's what I wanted to ask you. Like, you keep chasing it, but when? Like, when do you stop? When is it enough? When do you have enough of a project to interest someone else in it? And how much would that cost me? Like, if I want to buy your shares today, what's my timeline to hold this, and how much is it going to cost me in terms of dilution? I suppose that's kind of like the main two questions here.
Yeah, well, like I said, I'm not going to dilute at these levels to do what needs to be done here, because, and that's, I think, one of the reasons people have been reticent to get in the story is they can see how much capital needs to be spent on this, you know, and we need to be raising money at higher prices after we put out great results. I mean, that's the way this is supposed to work, is you raise capital on a premise, i.e., hello, investors, we're going to raise $10 million and we're going to go drill these holes. And this is what we hope to find. We did that part right. And then we get the result that we said we were going to get, even better, frankly. But then we're raising capital at a reduced market cap as opposed to an increased market cap. And that is the trend that me and my partners with the company, we're putting a stop to. And that's why we're thinking out of the box. That's why we're looking at an asset level deal. You know, I believe, and you know, we can break this into chunks, but let's just take the big picture on this thing. I think, you know, we need to spend, including property payments, everything, about $50 million on this project over the next, say, 5 years. So that's a lot of dilution if you lose our current share price. Now, obviously, I can't believe things are going to stay this poor for 5 more years, but just assume they do. So what's the dilution to current shareholders if I do that? They're going to be obliterated. We're going to look like one of those Australian juniors that's got 2.8 billion shares out, and everyone's proud about taking their stock from a dime to 15 cents. That's not the game I want to play. That's not, you know, my current shareholders didn't follow me or my group or the way we do things to have that be the end result. So we got to find a better way to do it. It's that simple.
Good.
And that's what we're doing.
Interesting. Yeah. Well, hope we can talk soon and you can update me on what that looks like specifically. What else are you doing in the meantime? You mentioned some permitting work. What is that going to look like more specifically? Anything major?
No, nothing major. It's just run of the mill. It's a process. The good news is nowhere on either one of our projects do we have any real environmental red flags. There's no endangered plants or animals or neither project, although we do have, there's zero community to worry about at Margarita. At Santa Cecilia, there's a community that has an area of influence. They don't live on the tenement, so they're off the tenement. It's not like we're impacting their homes or their lifestyle in any way, shape, or form. It's just part of their ancestral lands and so forth. So we're guests on their land. We've made a deal with them, and we'd be fools not to in any event. Even if we didn't have to, we would want to. They're living up there. They've got a community. They're a source of labor, water, all these sort of things, and so we've got a fantastic working relationship with the local community. It's, you know, even before the whole rise of this ESG and doing the right thing by the communities, those of us who have been successful for a long time, and I worked with the Hunter Dickinson group, and when I was 18 years old and started this business, they drilled it into my head, even though it wasn't discussed out in the world. We did ESG the way everyone's doing it now then, because it made sense. If you don't have the local communities on side, you don't have anything. You have nothing.
That's true. As proven by the recent history, basically. So
Yeah.
What else is happening then? You said permitting work. Wrote down a couple of things. What sort of the chronology as well? Because I think it's gonna be winter for you guys there soon down there.
It's winter now. Yeah.
Okay.
Winter
It's
now.
already, what is it, already cold?
Yeah, I think there's snow up there. I mean, it's again, we can get a whole other topic, but climate change is certainly impacted our business insofar as, you know, there's years where you curtail your activity because you're anticipating a big winter coming in, and it didn't. So for instance, last year at Santa Cecilia, we didn't have the capital anyway to drill, so we could have drilled right through the whole winter, because I remember one day, and this was just quite freaky, but it was at a time when there should have been 6 feet of snow up there, and it was 38 degrees Celsius. You know, that's they had a real warm phase come through.
Wow.
And it didn't last the whole winter, obviously, but just in one day in particular, that was particularly like, I think, you know, they got a lot more precipitation in Santiago last year than they're used to. And I'm just saying, there's like real, and I've seen that here home in Vancouver. I'm sure anyone out there who's watching this knows that, and has been on this planet for any amount of time, that the weather is not behaving the way you expect it to anymore. So now the norm is to expect that the weather's not going to do what you think it's going to do. That's the norm now.
But then if it behaves like you don't expect it to and you didn't expect it, then you're gonna turn very meta here very quickly. But no, you're right. It's been weird. And I've observed that at many places. But okay, anyway, so specifically, what are you doing? What else are you doing in the meantime? I mean, as it is winter over there.
We're keeping our baseline environmental work going, and we're keeping our permitting activities. These are not high cost things, but are high stake things, if you follow me. If you don't do your environmental work, that can create a bottleneck in your project development. If you don't do your community work, that can create a bottleneck down the road when you are ready to go. So say I get out and I get some sort of creative way to finance this project, but I've curtailed my permitting activities so dramatically that I don't have my permitting's not on track. It makes the ability to attract that capital for a different type of arrangement is going to be less attractive. They say, well, we can bring the capital, but we won't be able to spend it because you don't have the permits. So you must have your permitting, you must have your community on side, and you must do your environmental baseline work. Everybody else, including myself, is completely expendable as far as a Torq shareholder is concerned. How we live to fight another day and create value for our shareholders by keeping our assets as whole as possible. And that's what we're doing.
You also mentioned, or you had a news release that you appointed a new director, but that was after the sort of cash preservation measures, what I'm seeing on here. Waldo Kudara, what is, I suppose, what's the meaning of this is how I'd ask it.
Well, Waldo Quadra, he's a Chilean. He runs he's our general manager and runs the entire Chilean organization. So it only made sense to bring him onto the board. I mean, he was at every board meeting anyway, so we figured he might as well join us and have that Chilean national sort of participation at the board level.
Good. No salary, it's shares or options, or like how does that work?
We haven't set any stock options now. We've sort of, again, with what we're up to right now, it's not an appropriate time to be rewarding anybody for anything till our shareholders are getting rewarded as well.
But that is a fair point, and that's kind of the thing that I wanted to hear.
I mean, we all deserve it for how hard we've worked, but oh well.
Well,
we'll get paid when everybody else gets paid. Fortunately, we've had enough success in our lives that we can do that, and those people who didn't are no longer with us.
Well,
so
hope's gonna get you everywhere, or was it flattery? I don't know. I use both with my wife, and they get me pretty far enough. So.
Well, for us, what's going to get us over the line is belief. We believe we will be successful. We believe that these assets will deliver the way that we, for the reasons we acquired them. Nothing that's happened on either of these projects has diminished our belief in the assets. And I don't know about you, but I invest in assets and people too, but primarily the two aren't mutually exclusive. You need the right people with the right assets, or else you don't have a hope in hell in this business.
Good. Well, Sean, I hope next time we speak, it's better times for the stock price, better times for the market, and hopefully that's before long. I think I've been through most of my questions. We went through all the recent news release, the technical ones as well. So, is this something I'm forgetting to ask you? Something you came here hoping to talk about that I'm not bringing up?
No, I think we've really gone over it quite well. I think at the end of the day, just wanted to want everybody to take a look at that last drill program, because that's what people, I can tell you, my phone has rang off the hook from people who do get it, and it's not necessarily, you don't see it in the market, but I'm certainly seeing it in the quality of other mining professionals that are watching.
All right. Well, Sean, I hope it works well for you in the near term, and hopefully you turn this around. Hopefully you'll be back updating me on it soon. But for now, I'll let you drop off, as I will be traveling back to Europe, Northern Europe, actually, more specifically Sweden and Finland, to look at a large precious metals focused portfolio of assets that is held by First Nordic Metals, and hear about it from Taj and Adam, respectively, the company's CEO and CDO. The company is listed as FNM on the TSXV, where an average of about 190,000 shares trade each day, with a 52-week high of 29 cents and a 52-week low of 11 cents. With a market cap of about $41 million and about 185 million shares outstanding, today this is a 22.5-cent stock. I see 22.7 million warrants and 18.3 million options, resulting in, call it 225 million fully diluted shares. 21% of the company is owned by insiders, 48% is owned by strategic and institutional investors, and so that means there's about a third of the company that's in the hands of retail. This is where I typically walk you through the financials, so balance sheet, income statement, cash flow statement, to see how much cash the company had and how much of it was burning every month at the end of last period. But This is actually a recently formed company. I was going to say reformed, but that's not true because it's actually a new company that was created by the merger of RIDGELINE Minerals and RIDGELINE, after which the name was then changed to F&M, First Nordic Metals. So it makes more sense to be forward-looking here with the numbers, but to make sure that you're getting the full picture as a listener or a viewer and all the data you need to make a decision, please do head over to the company's website as well as setterplus.ca to look at all of the official numbers yourself. As to the projects that came into the company, this is now the largest development state claim holder in Sweden. It is in total over 100,000 hectares of mineral concessions that this company has. So a large land package where the flagship Barsele project is, and that's also where almost 2.5 million ounces of indicated and inferred gold is. That gold, by the way, is owned by a joint venture of Agnico Eagle and First Nordic on a 45% basis, with Agnico being the operator. So they can also earn an additional 15% for a total of then, well, I suppose 70% ownership in the project if they completed a PFS study on it, leaving thus a 30% free carried interest for First Nordic. But we don't care about land package sizes or ounces in the ground. Well, I don't. I care about a couple of things related to them, continuity and stuff like that, metallurgy that we're going to talk about later on. But I also mostly care about upside potential. And so First Nordic says that there's plenty of that left on the Barsele deposit, as well as the other land packages. And we'll see later on in the conversation what that actually means, especially because Agnico has recently started a 2,100 drill program, a 2,100 meter drill program, expected to be comprised of 11 holes, and it's designed to look for orogenic gold and VMS-style mineralization, mainly based on, well, previous work, obviously, but also geophysics that you can probably see on your screen right now. But again, more on that later on. As I mentioned, there are other assets in this company, though, 3 in total, 2 of which in Sweden, 1 to the north and 1 to the south from Barsele. They are both 100% owned by F&M. And so one of them is called Palladium. It's the more advanced of the 2. This is it's actually a drill-ready project, and we might see a program on it, on this one soon, supposedly a 10,000 meter drill program. Again, hoping for an update later on in the conversation. And then there's Storjukton that needs some more drill targeting work, like geophysics and stuff like that, to better understand the geology and then come up with drill targets. So it is further away from being drilled than Palladium. But again, hoping for another update on it, maybe a brief one later on. And then over the sea in Finland, another 100% controlled land package to the tune of, well, you can call it 18,000 hectares. It's 17,600 to be specific. Also a greenstone belt, like the other ones, by the way, with a small gold resource on it of a little over 300,000 ounces at almost 5 grams per ton in the indicated and inferred category. And as far as I understand it, this project is not yet on the schedule for drilling. So kind of on a back burner, actually. I haven't heard much discussion about that, despite, again, as far as I understand it, they're being ready to drill targets there. So again, hopefully an update on that later on. And actually, as I'm saying this, I realize that I've said it enough times that it's probably a good time for me to shut up already and kick off the actual interview with an obligatory first question here. But Taj or Adam, whoever feels comfortable taking this question, if I were to buy your stock today, how exactly are you going to make me a richer man, if you will? And what's that time frame that you'd like to achieve that on?
Yeah, Antonio, I'll start with that, and maybe Adam can add in. I mean, let's leave gold price aside. Gold price is going to move up, stocks will move up, explorers, developers, and producers. But let's just assume, regardless of gold price, I think there is a significant re-rate for First Nordic Metals that is on the horizon in the near term. I think this is a story that's kind of been forgotten about. It's an asset sitting inside a major that hasn't seen much work. The combination, as you noted, of Barsele and Goldline happened very recently. And Barsele at one point had a market cap of over 200 million market cap. Goldline at one point at its peak had a 75 million market cap. So that alone, and that's at much lower gold prices. But so that alone tells you the potential of what this could be. I additionally think that putting the packages together is probably, we'd like to say one of the smarter moves of M&A. It's a continuous land package. You've now potentially put together what could be, in the long run, Europe's largest gold camp. You've got 2.5 million ounces sitting on about 10 to 20% of the land. There's already indications of other Barsele style deposits on the package, and you really are, what's happening is you're trying to form a gold camp here of 5, 6, 7 million ounces plus. And I think as this just gets marketed, and as we continue to drill our properties and even advance Barcelli in conjunction with Agnico, I think there's huge room for a re-rate with the story. Adam, maybe you want to add some comments?
Yeah, I mean, going back to how we make money in the short term, I think we're going to find more ounces. Barcelli has had 165,000 meters of drilling to delineate, close to 2.5 million ounces. And the Pawbacken project, we hit on our third hole and have only completed 1,100 meters. So we've really just scratched the surface on a belt that we know is mineralized for over 60, 70 kilometers. We've got the Fabeliden deposit to the south. We've got the Svartaliden mine, which is about 4 kilometers from our discovery hole at Pawbacken, has been mined out. So there are ounces here that have been mined out for decades, and there's very little exploration that's been done here. It's one of the unique opportunities to invest in a belt similar to what you'd see in Ontario, which would typically be controlled by maybe 7 or 8 or 9 different companies. One company controls an entire greenstone belt in an underexplored region, which is one of the best places in the world to be doing business today. So I think that's how we make money in the short term. We go find more ounces, and we leverage the team we have in place to unlock the further value at the Barcelay deposit.
That's what the conversation is basically going to be built on, talking about how many more ounces. Maybe that's actually a good point to start on. How many more ounces are we talking about here? Is there an internal target that you're working with, and how much money do you expect you have to spend before getting to something like that?
Well, yeah, the Barcelli deposit currently is, as you noted, in all categories, about 2.5 million ounces. I think that's a pretty conservative 2.5 million ounces done by probably the best operator in the world, Agnico. I think if you were a little more aggressive, that number could come up higher anyway, if you were kind of a mid-tier and emerging major. But 2.5 million ounces there. It's been drilled to about a little over 500 meters at depth. We already know that we've hit mineralization down to over 900 meters at depth, and geophysics suggests that this mineralization could continue to close to 2 kilometers at depth. So I think really the most very obvious and natural way this deposit will grow is a long strike. 3.5 kilometers out of the 7 has really been tested, and that's what the deposit sits on, 3.5 kilometers of strike and at depth. And if you kind of put some high level numbers on what a potential target could be, I think 4 seems extremely reasonable. I think 5 and beyond is also very possible. That's just at the Barcelli deposit. And listen, as Adam had noted, we've got 100 kilometers of strike. The Barcelli deposit takes up only a small fraction of that. We know a majority of this strike is mineralized. It's a matter of just testing tanner grades, widths, etc. But we think there's very high probability, considering how underexplored this belt is, considering it's a greenstone belt, probably the last one that's really not been explored. We think there's high probability for 2 to 3 more Barcelli style deposits. So if you start putting another 1 to 2 million ounces on a couple more deposits, you're talking the potential of being close to 7, 8 million ounces and beyond as a larger, longer term target, really, and it becomes a camp at that point. And if you look at a similar greenstone belt in the Abitibi, Ontario and Quebec, you're talking about even more. So I think it's definitely in the realm of possibility. Adam, any comments there?
Yeah, what I would say is, all of the land that we have is covered by glacial till. So there's no obvious outcroppings. There's no easy way to go and find chip samples and find mineralized chip samples. You've got to do a little bit of work. You've got to do the geophysics, geochemistry. But again, I made the Pawbacken discovery on the 3rd drill hole with absolutely no geophysics. I shouldn't probably brag about that. My VPX was, telling me after the fact, what were you even doing drilling? And it was sort of a last hurrah for Goldline. And on our 3rd drill hole, we hit a mineralized target, 22.5 meters of 2.5 grams, a brand new discovery. And again, completely covered. You wouldn't see it otherwise, but it's sitting there under the surface. Really, Sweden only opened up to modern exploration maybe 25 years ago, 30 years ago. So we've only had maybe 15 good years of gold markets where you could actually go and do that work. And, from an access standpoint, we're less than 4 kilometers dirt road access to an operating mill. That in the coming years we'll probably need some feed for that mill. So very strategic opportunity for Pawbacken. We have a structure that continues all the way through Barcelona, another 50 kilometers to the north. So as every dollar is spent in the ground, we continue to learn and educate ourselves on the geology, the understanding of the mineralization, and leveraging Agnico's 10 years of work on the belt is going to be incredibly advantageous for the rest of our 100% owned projects as well.
I do want to talk about the geology, the targeting, and some of that glacial coverage there here in a minute. But there's something else I want to talk about first, and that's going to relate to following up on the question that I asked as to how much money do you spend on it. But I want to talk more in depth about the joint venture that you have. So as I mentioned, Agnico owns, as I said, 55%, can go up to 70%. Is that kind of the plan for you? Like, do you just let them do that, get the 30% free carried, or would you like to keep like co-financing this, or are there other opportunities? Talk to me about that.
I think there's a good amount of flexibility there. We're fully carried. They've already started drilling. I think 2,100 meters has been initially kind of allocated, but I think that's an initial. I think there's going to be follow-up on top of that, but we've been fully carried. There's already been about $60 million spent on the Barcelona project by Agnico. And listen, they can keep advancing it. It'll continue to de-risk it. That'll help kind of our multiple on that project. I do think, though, that there's a plan we also have is potentially to acquire the entire project, and I think that asset sitting inside a smaller company will be able to get the attention and resources and kind of marketing push it needs and deserves, and that might be the ultimate way to really unlock value of the Barcelona project. So there's a couple options. We can continue along the path we are and explore the rest of the 80 kilometers of strike that are 100% owned by us, and hopefully find Barcelona 2, Barcelona 3, et cetera, et cetera. That's already going to be part of the plan. But in specific for the Barcelona project, which is already kind of at a development stage, kind of advanced exploration development stage, maybe the best way is to eventually acquire it and push it forward that way. So a couple of different options that we're going to continue to work on and to see what makes sense. Adam, any notes on that?
I observe your interesting here. I do want to talk about these other options later on as well.
Sure.
But the current situation is what interests me the most, because that's the reality we have to work with right now. Why I'm asking this is because I wonder how you manage the relationship with Agnico in the first place. Because while also delivering and what you told me you want to achieve, which is more ounces, higher stock price, basically. And the first question is that, like, my interest, if I were to become a shareholder today, and Agnico's executives' interests are not necessarily aligned, as they're potentially looking for operational success that is potentially going to lead them to, promotion or advancement of sorts for their career, essentially, right? And I'm looking for a stock that goes up, in the simplest of terms. And so why I'm bringing this up is because this drill program that is currently going to be going on seems rather small, right? So how do you balance that relationship where the assets are being advanced at a tempo that will also please the stock market gods, while at the same time also keeping a good relationship with Agnico, which is the reality that you're working with right now?
Adam?
Yeah, I mean, I think one key thing, the merger that has created a company that now has assets that it can focus on outside of Barcelona. Agnico is a very different company than it was, 10 years ago when they first did the deal with Barcelona Minerals. They were a $3-4 billion company, and today they are a $45 to $50 billion company, highly focused on Canada, highly focused on their current jurisdiction on growing ounces without big capital expenditure. So I think there's a little bit of an alignment opportunity here where, Agnico does not necessarily have the focus in new jurisdictions as much as they might have 8-10 years ago, and they really need something meaningful to move the needle for their shareholders. And I think if they could monetize, the work that they've done and come up with a plan with a team that can execute, I think the combination of adding our own 100% owned projects, the combination of bringing Taj in, who's a proven project advancer, de-risker, is an exciting opportunity for Agnico to potentially do a deal with us where, we can go and prove out more ounces and maybe build a larger camp and align with some of their, longer term corporate, goals of being focused in North America. So I think as a shareholder, we have a new opportunity with a rebranded company with a new team led by Taj to show Agnico that this is what I'd like to do, and this is how, what we think it's worth. And, I think the valuation today at $40 million is really scratching the surface of where this could be, given the size potential, given the fact that you've got, a 100-kilometer footprint of a camp that can be developed. So, Agnico internally wants to, obviously, they've spent a lot of money and they want to get that money back and they want to benefit from the work that they've done, which they should. And I think Taj is, presented and will continue to present some, exciting opportunities for them to make some final decisions on.
You mentioned, Taj, that you potentially want to buy it back. Let's explore that option here a little bit too, as in how much money is that going to cost? But also why? I mean, based on what you know now, would you want to go and buy it? How much do you pay for it and stuff like that?
Yeah, listen, it's I'll go back into history. It was 2021, 2022. Discussions had already occurred between Barsele Minerals and Agnico for Agnico to put the asset inside Barsele. In fact, even press released. Unfortunately, at that time the markets were a little rocky. There was a bunch of things going on worldwide and specific in Europe, but also obviously just coming off the back of COVID, et cetera, et cetera. Barsele wasn't able to raise the money to continue to finish that deal off and get the assets sitting inside Barsele. But we know that is the ultimate kind of plan, and that's been discussed, and it's not a brand new thing. Agnico's already at the table with Barsele, which is now First Nordic. So it is a plan that is being considered and looked at. At a general high level, you can go back and see the press release, but it involves some combination of cash and shares. And so it was spread out over time. So something along those lines, and it was kind of in the 40 million or so range total kind of package size of cash and shares. There's some bells and whistles added on, but something along those lines, we think is completely doable by us, especially if it's spread out over time. And we think, based on the work we've done, the due diligence we've done, we think for sure we would definitely want the asset even for that kind of price. We think the net asset value is probably has the potential to be worth much, much more than that, multiples more than that. And there's already been quite a bit of drilling done, and there's a lot of data already there. So yeah, no, definitely, I think we would for sure be interested. I think it would be a huge value unlock if that asset moved into a company that had 100% ownership of it. And I think people are already at the table talking about it, and it has been for a couple of years. So that gives you a little bit of history on that item.
How are you going to finance it though? And what's the timeline that you're working with here?
Yeah, listen, I mean, it's in initial discussions, but like I said, some combination of cash and shares over time allows us to be able to tell the story, get the share value up substantially, and at the right times opportunistically raise some equity for making payments, and move it along that. It would definitely, it's not digestible to be able to do it all at once, and that's not even being considered. So I think the real way is to get the asset, talk about the asset, market the asset, talk about the whole package now, the whole company re-rates, and you're able to raise money at continuously higher prices and be able to chip away at it at that point. Look for potential other partners to come in who have an appropriate size. So it's I think there's a lot of options there.
And let me just add, I think the market doesn't fully appreciate that the work that Agnico has done here. Agnico could put out a scoping study today. There's enough work and there's enough technical work done that I think if we had operating control of the project, within 3 to 4 months, Taj could put out a PEA, and that PEA would be incredibly healthy and would demonstrate the full potential of the deposit. I think the market today maybe jumps to conclusions and says, okay, if Agnico's not moving it ahead, it must not be a good project. Well, when we were doing our due diligence on the merger, and the markets are efficient, so you sometimes scratch your head and say, how do you re-rate this? How do you get the story out? Taj did a lot of due diligence before the merger on the resource. The resource was done, I think, in 2019. He completed a full internal mine plan. And obviously we would not have gone ahead with a merger if we didn't believe there was a mine there today. So the way that we as a company would show the economics of the project compared to the way maybe Agnico would show their path forward. Agnico builds, beautiful world-class, production facilities, and the way they build projects, they build Cadillacs, they build the best of the best is really their mentality. And the way that they would show it, they don't need to show a project to try and sell a project. That's not what Agnico does. Agnico does internal numbers to advance the project. And if you're working corporately within Agnico, you want to overperform and you want to over deliver, which means the way that you set up the project versus the way a junior would maybe, or a mid-tier would show the economics. We could build a smaller plant. We could get a little bit more creative. So I think they understand and appreciate that Taj has got a lot of experience on capital allocation and how to move a project like this forward. And in Taj's hands would be a very exciting project to show it to the market. We can't talk about those numbers publicly, but we obviously would not have moved forward if we weren't incredibly excited about having 45% of an incredible project.
Why would Agnico let it go though? I mean, if it's that good of a project, they must see it. I mean, they're the operator of the project, so why would they potentially want to get out of it and give it over to you?
It's size, right? Adam talked about it, Antonio. A couple 100,000 ounces a year in a new country, right? When you're so busy with your existing operations, is a couple 100,000 ounces a year going to move the needle for Agnico? No, but for a mid-tier, it will massively move the needle. For even an emerging major, it will. So the company has grown, very well, and there's certain assets that now fit the bill for them. There's different hurdle criteria, both for cash costs, both for size, both for kind of return on capital. So I think it's an amazing opportunity. We've seen it across the sector where it's an asset that a senior has, and they're kind of like, we're okay, we're done with it, and they give it on to a mid-tier or even a junior, and the thing comes to life, and it's $1 billion company that went from 30-40 million market cap to $1 billion within a couple of years. We've seen that a few times, and a lot of times with projects, it takes the third or fourth kind of operator to really unlock the value there. And I think it's a matter of just simply of size, right? $3-4 billion company when the joint venture was announced over a decade ago, and now close to 50 billion market cap. Different things are going to move the needle for that kind of a company.
Well, but listening to you explain this, it makes me think that it's basically the only realistic way forward is for you to get full control of this asset, because otherwise, if that's all true about Agnico, then they're just going to drag their feet if this is not the right asset for them. So what do you also see it as pretty much the only viable way forward?
I don't see it as the only viable way forward, but I think it'd be the best way to unlock the value for the asset in the quickest amount of time, for sure. And I think they see it too.
Okay.
So yeah, we'll continue discussions, and again, listen, you have to think about if this vision we have of putting 8 to 10 million ounces comes together in a much larger central processing facility, then the story starts getting different. But I think Agnico is really focused on his existing operations, looking for ounces near mine, really focused on Canada, obviously, as we know. So it's sometimes a good idea. Put it into someone's hands who can really progress it rapidly, and bring the right people in to keep backing it and go from there. So yeah, I think that's the fastest way to unlock the value, for sure. Whether it sits fully in Agnico, which is also an option, or whether it sits fully inside of a junior.
I think I'll add, sorry, just to add to that. When Agnico first did this deal, we know they were a much smaller company, and we also know the price of gold was maybe what, $1,300-$1,400. Today, the price of gold is $2,300-$2,400, and we're in this business because we think gold is going to 3,000 or 4,000 or whatever it may be, and unlocking the potential of a deposit like this is a very unique opportunity. It's not like you're finding 3, 4, 5 million ounce deposits all around the world yearly. The number of discoveries have dropped. The amount of exploration dollars that have gone into the ground globally have dropped. Reserves have dropped. I mean, everything is pointing in the direction of it's not easy to go find ounces. What used to be, 1 million ounces used to make your company, and you'd be, off to the races, 10 years ago, 15 years ago. Today, now we've got a base, of 2.5-3 million ounces with this project. We've got another project in Finland. We've got the rest of the belt to explore. gold goes to $3,000 an ounce, this project torques incredibly, and maybe the perspectives change, and maybe someone comes in and offers cash for the whole thing. There's a lot of different ways that this can be unlocked. We're working hard to present the right case and the right structure that doesn't impact our upside. We want to make sure the stock can go up so that we can raise money higher. And again, doing a deal that allows Taj to go talk about the economics of the project and his plan is the best for everybody. And I think Agnico, again, as we mentioned, they're growing by acquiring ounces near their current production facilities. They're not going out and spending money building new areas, new camps. Their growth has got very little impact on the environment. They're very conscious of making sure that they're attracting investment from, not just the gold funds, but specifically the generalist funds. They really want to get that investment from the generalist funds, and growth without big capital expenditures, how that's going to continue to get their share price up. So they're making cash, tremendous cash flow out of Kittilä in Finland. These are great jurisdictions. They've got no more capex in Finland, and they've got a healthy piece and controlling piece of this great asset in Sweden that we have continued to communicate to them about our plans, and we will continue to do that systematically over the next 3 to 6 months and work towards some sort of a potential opportunity for everybody.
And I think, just to add, to close off here, sorry, is the fact that these things are together is what really makes the thing work, because you've got all in the same belt, a development stage project, but now you've got all this exploration potential and sizzle and blue skies that you can talk about that's not being priced in at all. And it's all in the same area, right? All the learnings about the geology, about the metallurgy, that we get from, for example, from Barsele, and exploration methods that work, we can apply those across the whole belt. And so I think a near-term, mid-term catalyst is if we can really show some potential meaningful size of a new deposit, and of course we already 100% own, we're surrounding the Barsele project. That's really going to make the story take off even further.
Right, and to go back to sort of how do I make money on the stock and what's the timeline behind it all? If you buy it back from Agnico, as if it were like if you buy the whole thing back from Agnico, how long is it going to take you to prove it up to be big enough so that someone else comes in and then buys it from you? As well as who's that person, who's that company going to be? Like, who buys it from you if Agnico doesn't want it?
Yeah, so the timeline is pretty easy. As Adam had noted, there's already everything you need for a PEA is already there, done. Like the Agnico's done it, we've even done it. We did it in our due diligence. You could get the deal done and put a PEA out within 4 or 6 months, a very strong PEA that would show some really, really serious economics, we believe. And of course, that would attract attention. That would allow for a significant re-rate of the story. And of course, I think, yeah, at that point, you're going to have some larger mid-tiers and emerging majors who would be interested, right? There's quite a few names of people who'd be interested, I think. And there's not a lot of assets that have that kind of size, 3 million ounces. Like, think of how many deposits out there are there that are this kind of size, say circa 3 million ounces, that are not sitting inside a major. There's not many. There's probably under 10. Rupert is one of them, and they've done a great job, just neighboring us in Finland. But there's not a lot, so I think it would attract a lot of attention. You're saying who, you could go down the list of kind of emerging mid-tiers. There's the IAMGOLDs, the Santeras, the Eldorados, Lundin. You could start talking about, other larger European-based companies like a Nordgold. There's quite a few, I think, options where people would look at it if this was 100% controlled by one company.
There's as I mentioned at the beginning, is size is not the only thing that matters. I always joke about it, me saying the same thing to my wife. She doesn't necessarily buy it, but looking at the cross section of this deposit that you have here, it also looks patchy, sort of, but so potentially a high strip ratio as it occurs in this sort of a parallel to subparallel lodes, if you will. So are they is Agnico or are you going to be doing any work to prove up or improve, better said, on the continuity of the deposit if you gain control of it?
Actually, this deposit is primarily underground. There's a starter pit of about 300,000 ounces. The rest of it's all underground. Shallow kind of underground, very wide zones. That's what helps the economics. You're talking about zones of up to 120 meters wide, but probably even at the minimum 5-10 meters wide at the minimum. So this is a long hole open stoping mine. Maybe even you could think about a sublevel caving. And it's no, the economics are extremely strong because of the width of these zones. The grade is probably, if you compare it to Rupert's grade, we're probably 30 to 40% higher than Rupert's underground grade. But Rupert has a beautiful open pit. But if you look at it like a Young Davidson, Alamos, one of Alamos's flagship mines, very similar widths, and that's a serious moneymaker for them. You compare it to a mine that's in Sweden called Björkdal, owned by Mandalay Resources. Underground mining, long hole open stoping, exactly what we contemplate here. Their head grade's about 1.5 grams. We're at 3. And that mine's been operating since the early 90s, I believe. So listen, the economics are going to be very strong because of the width of these zones, and it's underground. And listen, there's a push here, probably worldwide, but especially in Europe. They like the underground mines, right? Smaller footprints, smaller capex, higher margin. So that this is, in our mind, this is an underground. All the economics are pushed, and by the underground. This is an underground mine.
Robert, so is there something you can do regarding the continuity? I mean, it's just the visuals of that cross section on one of the slides on your presentation. Like, one of the first things that kind of hits you when you open it up is that deposit sort of occurs in these, again, sort of patches. Is there something you can do about that?
Listen, the deposit is a combination of indicated and inferred right now. The inferred, I think, as we bring it up, you'll get some grade to come up anyway. You're right, but yeah, for sure it needs to be drilled. The inferred needs to move into the indicated, but I mean, this resource, there's been 4 or 5 iterations of this resource done, including an internal one done by us, and I will tell you, it's disseminated. There's areas where you have higher grade gold, but there's been full mine plans put around this, and it works. So yes, for sure, you're going to need to do upgrade drilling, which I think will probably improve grade anyway. But yeah, no, definitely, I think you're gonna have a cohesive deposit here for sure.
Okay. And then metallurgy, I mean, you mentioned the potential economics here. That's the forward-looking statements we always talk about. But you mentioned potential economics here, the deposit. You need to have metallurgy in order to really make a claim around that. How's the metallurgy here?
So there's been about 5-6 met programs done on the Barsele ore. Free milling sulfide ore. So recoveries ranging anywhere from 91, 92 on the lower side to 96, 97. Yeah, beautiful stuff in terms of metallurgy is what we're seeing so far. Very similar to what Rupert has at Ikari. So yeah, no, the metallurgy is, as a metallurgist, metallurgy is probably one of the first things I'll look at when you see that is there potential for deposit here, and it was important on my checklist, and checks out really well. And actually, in fact, huge component of it is gravity. 40-50% of it can be recovered through gravity. So that, again, will help the back end of your flow sheet in terms of keeping it down in size, and things like that. So there's potential implications where, the kind of economics we've internally done, maybe you can get even better as we continue to optimize, but a lot of really good characteristics. Of course, grind size so far based on what we're testing. A lot of good metallurgical characteristics of this ore, which again, exactly as you point out, help the story further.
It's interesting you mentioned the gravity there, because obviously recovery rates matter. That's the first thing I want to see, and thank you for answering that. But then also deleterious elements matter too, because why I'm coming up, or where I'm coming from with this, and why I say the gravity thing is interesting, is because as far as I understand it, the host rock geology is kind of different from one part of the deposit to the other. And so, I mean, there's different styles of mineralization too, as far as I understand it. And so I'm wondering if doing that met work will not only help you better know and understand the deposit, but also help you come up with maybe better targets for growing this along strike. I don't know if I'm making any sense here. I'm not a metallurgist, but that's kind of the running thought that I'm having here.
No, listen, the work program and the you're talking about is completely true. You have to know the different ore types. that you have in the deposit and test them separately, test them as blends, test them, here's a year 1-3 blend, etc. as we get down the road. But yeah, no, completely agree. Generally though, this deposit is pretty simple. It's intrusive hosted, shear zone controlled, orogenic kind of vein hosted, some sort of components of orogenic disseminated, but pretty similar across the board from what we're seeing right now. But definitely agree. All of the points you bring up on what needs to be done down the road for sure should be done and will be done. Yeah.
Is Agnico doing that anyways this year, irrespective of whether you get a deal on it or not?
Listen, the network has gotten to a point where it's good enough for a PEA and probably even a PFS. So I think what Agnico wants to do is make sure they didn't leave an elephant out there. I think that's what's going on. And so I think the mat work is done enough to be able to publish, and there's good solid backing and what you're going to be getting in terms of overall recovery, general flow sheet. So the focus, I think, will really be kind of doing some wildcat drilling, which is what you can see from the release they put out. You're trying to grow stuff near mine, but you're also trying to do a bit of wildcat stuff on some really interesting targets based on geochem, geology, and geophys, all the layers. So yeah.
How's that drilling going so far? Is there anything that you can talk to me about?
It just started actually. Adam, right? Early May, kind of started, mid-May.
Yeah,
So,
just scratch, just getting started essentially.
Exactly. So.
But they're doing shallow holes. So I mean, what you just said, Tash, how is that going to help them? I mean, see if they're leaving an elephant out there, given how shallow it is.
There's a lot on this gold line belt. A lot of the deposits, whatever's been discovered so far, is pretty shallow. Like this discovery hole we had at Powback and was right below the till, a few meters below surface. I'm talking 10, 15 meters below surface. 2.5 grams per ton. 20, 23 meters or whatever. No, this is how these deposits start. They start shallow and they continue for serious depths. That's this style of system we're dealing with. So the shallow holes are important. And then if you think they continue, you can go from there. But what I'm trying to get at is that I don't think they're trying to do upgrade drilling at this point. They're trying to look for really wide space stuff and to test the true extent of the system. And even the ones near mine they're doing are big step outs, right? Because if they hit a big step out, then suddenly you're talking about a different size of system. And I think they're just doing that as part of their work to look at the size of the system.
Well, so if they're essentially checking the cupboard for extra pennies that they might have left before they sell the car, type of thing here, would it be reasonable to say, like, okay, we have to wait and see if there are pennies left in the car before you actually work on a deal? As in, do they have to be done with this program and then you start working on a deal, or could it happen in the meantime?
No, it definitely could happen in the meantime. That they were already talking about a deal a few years ago. I think they'll maybe want to maintain some exposure to it. So they'll be able to come back in case something happens. I think would be a strategy that I think a major would have. But no, I don't think I don't think they're waiting for that before they can talk about a deal. No, definitely not.
Okay. What do you do in the meantime? Do you go to pullback in this year? Do you actually want to drill it? Is that reasonable to expect?
100%. Yeah, we want to drill that. In the next couple of weeks or so, we've done at the end of last year, early this year, had done quite a bit of geochemistry work as well as bot drilling at the Powback asset. Bot drilling is this base of drill drilling on grids. That is a very typical methodology they use in this environment. And so we're going to be putting up results on Powback and on that, as well as testing Storyukton. We did a very extensive geochemistry program at Storyukton. I think within a couple of weeks or so, we'll be putting out results there that will then allow us to build and outline a program for both of those projects, kind of starting late summer, early fall. Adam, any points on that?
Yeah, I just reemphasized the Pawbacken project. This is a 40-kilometer land package. There are 3 to 4 kilometer structures on that belt already. The Aida target, which was the main discovery hole that we made, that itself is a 5-kilometer structurally controlled corridor. We've done, short fences across that structure. We know it's mineralized for 600 meters. We know that 5 kilometer belt has to be tested, and we know we're going to be able to extend that mineralization. So the footprint of that is larger than Barcellay today. The mineralization is at surface. We've only drilled down to maybe 150 meters, so we've really just scratched the surface there. And a dedicated drill program at AIDA could be an incredible, unlocking event for First Nordic shareholders. And again, that is a dirt road access to the Svartaliden mill and mine, which was mined out. I think they mined out just under 400,000 ounces, 10 years ago or so. I believe the Svartaliden deposit continues northeast, and that's exactly where the AIDA target is. So I wouldn't be surprised if there's some underground connectivity between those at some point. But yeah, listen, we're on the map now. We've merged the two portfolios. With the AIDA target at Pawbacken is the obvious thing for us to drill here in the short term. And I think you're going to see 2 to 3 other, 3 to 4, maybe 5 kilometer structures identified and ready for drill testing later this year. So we've got a lot of work we can do now and build the excitement around new discoveries on the belt, and at the same time, continue to work with Agnico on finding some sort of a, collaborative solution there that allows us to start moving forward on the project. Keep in mind also on the Barcellay, that part of the Barcellay, the Gold Line belt, is the intersection of the VMS belt, which, you've got over 150 deposits have been discovered on that belt. Boliden, that is essentially the belt that made Boliden the company they are today. There's over 30 producing mines on that belt, and that structure goes right into the Barcellay deposit. So when Agnico's out there testing, they're testing different styles of mineralization. You've got a lot of sort of flexuring and changing of mineralized structures in that area, which is obviously very exciting. And they're testing for the VMS potential on the belt as well there.
There's as you mentioned, Adam, earlier, there's a glacial cover on that main AIDA target back at Pawbacken, I believe. So it's essentially making it harder, or a bit harder at least, for you to come up with targets. How are you solving that?
Yeah, so we know the geophysics shows this north south structure that's identified. Originally, when we made the discovery, our partners EMX, and we did bot drilling. So these bot drills are about 30 meters long. They're smaller than core. They cost about $1,000. So you go and you do a grid and you go across. And as we went east-west, we hit 2 main structures that were mineralized, which turns out are the controlled structures within the belt. So as we did these long horizontal grids, we found a couple of markers of 3-4 grams per ton. We drilled underneath that. We made our discovery. So now you've got this 5-kilometer structure that we've gone and created sort of these short fences. So these shorter lines along that structure. And what you're going to see in the next few weeks is the results of that bot drilling that would then show essentially chip samples below surface. So it costs you a little bit more money. It takes a little bit more time, but it's essentially like, just taking chip samples at 15, 20 meters depth. And we've got that done now. So when those results come out, you're going to see probably an extension of that structure and basically setting it up for diamond drilling.
How much is that going to
Yeah,
cost,
just
by
to
the way?
point out, Antonio, this is the common method that the Agnicos, the Ruperts, the B2s, this is the common method they use for deposit discovery in this terrain. So it's a pretty tried, tested, true method. And I do want to point out while we're on it about drilling is, having worked in many jurisdictions around the world and having doing due diligence on many deposits all over the world, both in terms of exploration and production, eventual production, this region has unbelievably favorable cost, probably top decile, which is very surprising because you think of Scandinavia.
How much is it per meter?
You're looking at probably $200 to $220 a meter core diamond drilling, which having worked in many jurisdictions in the world is like I said, probably among some of the best. And the main reason, access to skilled labor is there, of course, and they're it's a kind of in terms of operations, very mechanized and efficient at mining, but the access to low cost power is huge. I mean, we're talking about 3 cents a kilowatt hour. That's probably the cheapest power you can get in the world. And again, it's all green energy with hydro. But yeah, it was something that was very surprising to me. The exploration costs, how favorable they are, but as well the production costs.
Yeah.
When you start comparing underground mining costs versus other jurisdictions, it's extremely favorable. And this is like if you look at the Kittilä mine in Finland, it's 4.5 gram per ton or so underground, and it's refractory. So way higher processing costs than kind of a free milling sulfide deposit, but it makes lots of money, even at such kind of a low grade, if you will. And a big part of it is because the unit op costs are so low in this part of
Right.
the
But
world.
so essentially for this program, and I know that you gentlemen have to go here in a couple of minutes. That's why I'm kind of rushing through it. But you need
Yeah.
what, $2 to $2.5 million you need for this drill program. How much do you think the company is going to run in terms of G&A a month or a year, however you look at it?
Yeah, we're really lean as it is. It's pretty much myself and Adam. A team in Europe is primarily contract based. We use EMX royalties, technical services team, and again, a lot of the other overheads and stuff is covered by the Barsley project and Nico's costs. So look, we're going to be very lean. Probably $200,000-300,000 a year, kind of G&A, maybe the better part of $500,000 is all we really need. But really, the main thing is all this money that we'd like to get is to go into the ground. Exactly.
Okay. So how much money do you have right now? And where are you going to go to top up to that 2.5, is $500,000 G&A? So about $3 million is what you're going to need from now on to have a drill program out and announced in the market. Where's that money going to come from?
Adam, you want to comment?
Yeah, so we've got ongoing warrants that are close to in the money, that have been in the money. We've got we will go to the market at some point. We don't think we need to do that now. We'd like to do that at higher prices. We've got a lot of news that needs to come out still. So as soon as that news comes out, we'll determine where the market is, and we'll do a small financing at some point in the future. We've got about $1 million on hand, but we could bring in $3 to $4 million in warrant and option capital if necessary as well. We've got great shareholders that have been very supportive, and we think that could be the warrants and options could be utilized. And ideally, we'd like to do a financing. We do have strong institutional support out of the U.S. Those investors have not invested in the company more recently, but we think we're going to get continued support from some of our larger funds, and that will lead to a less dilutive financing at some point in the future.
Good. And then the other projects, maybe one last point to touch upon. They have there Finland. You have another project that I mentioned earlier that is at an earlier stage in the Lassonde Curve. I don't assume there's any work planned on there, but are those projects? I mean, is there a for sale sign on them, or is there a for optioning sign on them? Could you use them for alternative forms of financing? How do you look at them?
Listen, I think those Finnish projects, and Adam's the one who acquired them. They were discovered and developed to a maiden resource by Agnico. The Oiarvi project, that's just it's a very strong project with fantastic grade. You're talking close to 5 gram per ton, as you mentioned, Antonio. Smaller size resource now, significant potential to grow it. It's currently occupying about 1.5 kilometers or so strike. There's obvious kind of evidence that this is at least a 4-kilometer strike. It's only been drilled to 200 meters. It's pretty obvious this goes to hopefully towards about 1 kilometer in depth, based on what we know about the systems, similar systems around. So listen, it has growth potential. I think it's probably could sit in its own company at some point, but we've got it in our portfolio now. We're looking at options for it. It could be ready to drill by the winter. And there's very obvious targets for us to drill. So yeah, listen, we're really focused on Sweden. We think the lowest hanging fruit is Sweden, and we're really focused on it right now. But that's in our portfolio. It's huge option value, and it's probably beyond that now. But we're looking at different scenarios for that.
Good. Well, gentlemen, our time is up. I know you have to go now, but thank you so much for sitting down with me. It seems like there's going to be a lot more updates over the coming months that we can talk about, and hopefully you can come back to update me on. But I really appreciate you investing your time in me, and thank you for this update.
We really appreciate it, Antonio. Thank you for having us.
Thanks, Antonio.